Hello, everyone who's joining us in the background. We're just letting everyone get sorted and join the webinar. Thanks to all of you who've joined us early. We'll start in 5 minutes' time, so feel free to get yourself a drink or just introduce yourself in the chat if you'd like to do so, and we'll be getting started shortly. Thanks, everyone. Hello, good morning, good afternoon for those who are just joining us. We're just about to get started in a 1 moment's time, so thanks for your patience whilst we just wait for everyone to join us in the session. So feel free to introduce yourselves and we'll be getting started in just a moment. Thanks. Okay, hello everyone. Thank you to all those who've recently joined the session. Great to have lots of you here with us. So I think we're at the hour mark now, so we'll get started with the training session. So firstly, a big hello and welcome from me. I'm Fiona from the UN Sustainable Stock Exchanges team, and it's great to be here with you all for this half day of training on applying the IFRS Sustainability Disclosure Standards. This training program is truly a very collaborative effort, really driven by that demand that we're seeing in the market for more support to implement the IFRS S1 and S2 standards. So firstly, a few thank yous from my side. I'd like to say thank you to the IFC and IFRS Foundation, our partners on this program, and of course the Muscat Stock Exchange for hosting us together today. And finally, a big thank you to all of you who've joined us as participants in this training session. We know it's lots of time to take out of your day, so we really appreciate the time that you're dedicating to joining us on this topic as well. So to get us started, I'm very pleased to say we're joined by Majida Al-Mamari, the manager of the Sustainable Investment Centre at the Muscat Stock Exchange, who'll be giving us a few opening remarks. So a big thank you for joining us, Majida, and I'll hand the floor over to you now. Thank you.
Thank you, Fiona. Thank you, everyone, and good morning for everyone. Thank you to join us today. And we are very blessed to welcome you to this capacity building training on the ISSB and IFRS Sustainability Disclosure Standards. This is the second time we are hosting this training, and we are excited to see a strong interest once again. And last year's session had a great turnout and engagement. Since then, a lot has changed with the ESG disclosure now becoming mandatory in Oman. And this topic is not just relevant, it is essential. At MSX, we are support the market transition, and that means helping organizations across sectors understanding how this global standards work and why they matter. Let's make the most of the session. And once again, thank you for being here. Thank you, Fiona, and from SSE and the another organization. Thank you.
Thank you so much, Majida, and fantastic to hear about the progress being made in Oman in sustainability reporting. So I think hopefully a well-timed session today to support that journey that the market is on. So great to hear, and really appreciative of MSX fantastic work on this topic. So with that, I'll now be getting us started with a few introductions to the session. So I'll get started with just a couple of housekeeping points firstly. So you've probably noticed by now as a participant that you are muted during the training session. However, please make sure that you are using the chat function and the Q&A box if you'd like to interact with us during the session. So you can use the chat if you'd like to share any sort of general comments, maybe say a little bit about any reflections on what we're hearing or what your organization is doing on these topics. But if you have any particular questions for the team, please make sure to post those in the Q&A box, which you'll also have as an option within Zoom. And that will just allow us to keep track on all of the questions we're getting and provide your answers, because as you're seeing already, the chat can get quite busy. So if you ask your question in the chat, it might get a bit lost. So make sure to use the Q&A box for any questions for the team. And then in terms of the format for today, so you're probably aware that we have a live 3.5 hour training session today. As I've mentioned already, we'll have live question and answer opportunities throughout. So please do make sure to make use of that to get your questions answered that you might have. So there's a number of us who will be speaking today, which I'll introduce. Obviously, those who are not speaking are able to answer questions in the background. So please make sure to ask your questions and we'll answer those as we go along. We also very much encourage your participation in the training session as well. So we're going to be using a number of interactive features in the training, including Menti and polls. So it'd be great to take part in those as well. And finally, for taking part today, you're also able to receive a completion certificate To get your certificate, you'll need to fill a feedback survey out, and we'll be sharing the details with that at the end of the training session, since you need to join us for the full training to receive your certificate. And so just to say a little bit about who's presenting today. So as I said, I'm Fiona from the SSE Academy team at the UN Sustainable Stock Exchanges Initiative. And I'm joined by my colleague, Lois Guthrie, who's just appeared to give you a wave there as well. Thank you, Lois, who's our senior success specialist as well. And then we're very pleased today to also be joined by our colleagues at the IFRS Foundation within their capacity building team. So we're very pleased to have Robert Swiatowski, who is a partnership manager in the capacity building team, and Vanessa Hay, a capacity building fellow, who will both be speaking later on in the session as well. And also a fantastic opportunity, as I've said, to make sure you ask your questions, which Robert and Vanessa will be doing their best to answer too. So as I said, please make sure to write your questions in should you have them. And for today's training session, we've really got 3 key learning objectives that we hope to cover with you. So firstly, we're hoping to help you to understand the ISSB standards. Secondly, we'd like to help you to understand how you can use the ISSB standards in your reporting. And finally, we'll be focusing on identifying the steps that you can take to develop a disclosure plan in order to apply the ISSB standards. So to take us through those 3 learning areas, we've broken our training down into a format to really help simplify this and take it step by step. So we have 4 different modules that we're going to be working through in today's session that you can see in the sort of wheel diagram on the screen at the moment. So starting with our first module, Prepare, we'll be thinking here really about building on your existing knowledge of reporting, thinking about the purpose for sustainability disclosures, the overall landscape for reporting, and how the ISSB's global baseline has developed. We'll then move into Align, which is all around setting the direction for your reporting. So thinking about how to apply and use the standards and what additional disclosures you might want to add to your reporting as well. In Implement, our module 3, we'll be thinking more about the practices and systems that can really support you to identify, evaluate, and integrate sustainability risks and opportunities in your organizations and your disclosures. And then we'll finish on Communicate. So this is all around the final format for your reporting. So thinking about the location and timing of reporting, how to do so with efficiency and with confidence. So just to show you how our training agenda breaks down across those 4 modules. So we'll be breaking up the first 2 modules across the sort of top section of the session, with a little bit of module 2 after our break that we'll take in the middle as well. And then the second 2 modules in the latter part of the session. And then we'll close off with some extra time at the end as well to share with you some more resources and talk to you about the homework exercise, which I'll mention in a moment as well. So firstly, I can see this question has already come up in the chat, but just to be clear, we are providing access to the training materials from today's session, which will include the slide presentation and the homework assignment that I mentioned under the resources section on the SSE webpage. So Lois will shortly just share that link with you to the webpage in the chat box. And if you go to the resources section at the bottom of that page, you'll be able to find the slide presentation and the homework assignment there. We'll also post the recording for today's training session after the webinar onto that page as well. And as I've mentioned, there is an optional homework assignment that you can choose to take part in after the training. And this is all about developing a draft disclosure plan for your company and using what you've learned in this training program. So it's not mandatory to complete the homework and it's not something that you need to submit to us. However, if you'd like to use it to support your own learning and to build your experience and support your internal conversations, we'd encourage you to check out the homework assignment, which, as I've said, you can find on the web page there that Lois has shared with you. And just to mention a few of the key resources that we're going to be drawing on in today's training session in the content. So we have the SSE Toolkit of Resources, which goes into further detail on the 4 units we're going to be discussing today. So if you want to find out any more information about some of these areas, you can check out these different guidance documents within the toolkit available on the SSE webpage. And you'll find the link to that following the QR code there. Or if you download the slide handout, that will give you URL links to access lots of the resources we're going to be talking about today as well by clicking on them in the presentation. So encourage you to do that so that you can follow along. But we'll also share with you some of the links again in the chat throughout the session as well. So a number of different ways to access these things. But firstly, to get us started with a bit of interaction and get familiar with using Menti, which we'll come back to a few times throughout the session, we have a couple of quick questions to get started on together today. So the main way to access Menti is going to be to follow the link which Lois is just about to share with you in the chat. So I'll just give it a second there. Great, thank you, Lois. So if you just go to that message that Lois has shared, you can follow the link to join us in Menti. And what I will do now as well is I'll share my screen, and that will give you another couple of options to join us in Menti as well. Okay, so as I said, the main way, probably the easiest way to get to Menti is to follow that link that Lois has shared with you. But a few other options would include using that QR code that you can see on the screen in front of us there now, or also going to menti.com and entering the 8-digit code that you can currently see at the top of the screen. But our first question, just as a bit of a warm up, really, is just to get a sense from you all, in your own words, about your reasons for joining us in today's training session. So, yeah, just what are you hoping to get out of the training, or maybe what topics you want to know about? Great, thanks everyone who's already taking part in that. So, I'm seeing better understanding, sustainability, maybe understanding the difference between the IFRS and other reporting standards, thinking about risk management, disclosures, sustainable development, thinking about how to be more comprehensive in our reporting or refresh our knowledge. So fantastic. Lots of slightly different but all very connected perspectives on why you're here with us. So thank you for sharing. And that looks like that's working well for lots of you to access Menti as well. So that's always great. As I said, we'll be doing a number of interactive exercises during the training. So recommend finding your way to Menti now so that you can use it for those exercises later in the session. Excellent. Thanks, everyone. So lots of great words there, and I hope all things that will be able to help you to advance in today's training. So I'll move to our second warm-up question now, which is just to get a sense really from everyone here on your current understanding and comfort on those different learning objectives that we talked about at the start of the session. So you have a sliding scale to let us know from not very comfortable at all on the left-hand side, maybe just at the beginning of your journey of understanding these things, to quite comfortable and maybe quite experienced on these topics on the right-hand side of the scale, to let us know, where you're at with your current understanding on how to explain what the ISSB is to team members, on using the ISSB standards, and on developing a sustainability reporting strategy. Great, I can see lots of you have taken part here. And we have maybe a little bit of a range overall, but it looks like perhaps people are feeling more confident so far on developing a sustainability reporting strategy, but perhaps a little bit less comfortable with the specific use of the ISSB standards or explaining that to others. So, of course, that's very understandable, and that's what we're here for today, to help support you in advancing your understanding on these topics. But always just good to get a sense to start with of where everyone's understanding is at. And for those of you who maybe have some experience on these topics already, it's always great to share your perspectives as well. So do please share in the chat if there's anything you'd like to share about what you're already doing in these areas. Okay, perfect. So I will just take us back to the slide presentation now. But if you keep that Menti window that you have open there, open as a tab on your computer, that's likely going to be helpful because we'll come back to Menti again later in the session. But we will also reshare the link with you for that so that you can access it again. Okay, so I'll get us started now and just kick off the first module. So the first thing just to cover is a brief disclaimer, which I'll leave for you to review for a moment. This disclaimer is really just to be clear about how we're going to be using examples in today's training session. So these are very simply here to help add some colour to what we're talking about. Sometimes we know it can help to see a real example to put into practice what we're discussing. However, the examples that we're using shouldn't necessarily be seen as the best way or the right way for a company to approach these things. Of course, we know that each company's circumstances are unique, so you should do what suits you best. But really, these examples are used just to give a bit of inspiration as you get started. Okay, so with that clarified, I'll now kick us off in module 1, which, as I've said, is all around this foundation of knowledge here. So building on what you might already know about sustainability reporting, like the standards that were already in place and have informed the development of the ISSB. So here we generally like to cover 3 important aspects. So firstly, the purpose, so all around why we disclose sustainability information, the case for sustainability reporting, and the market and business case for it. We'll then move into landscape, so thinking about how the reporting landscape has evolved and including how it's becoming simplified. And then we'll close off this module with the global baseline section. So this is finally providing an overview of the S1 and S2 standards and the core concepts and requirements that provide this global baseline. So to get us started with the why aspect, we're going to be looking at the purpose. So we'll first dive into the case for disclosure and what some of the market drivers are that might be informing companies' decisions about reporting. So to get us started with that, we'd firstly like to hear from you as to what your particular drivers are for reporting. So I'll just launch a poll now, which should pop up on your screen for you in a moment. And in that poll, you can select as many answers as are correct for you to let us know really what are your reasons for disclosing sustainability information, or if you're maybe not from a company who's doing the reporting, what are your reasons, for other organizations that you work with to want to focus on these things, and what do you think are the top market drivers that you're seeing for reporting? We know some of you might be right at the beginning of your journey on this as well, so also feel free to let us know if you're just getting started. Or if you have any other reasons beyond those you can see in the poll option, feel free to let us know those in the chat as well, and it's always interesting to hear what those might be. Great. I see lots of you taking part, but we'll give everyone a few more seconds to participate. We always like to see as many people taking part in the polls as we can, so great to see we're getting a good participation rate here. But in the interest of time, I'll end the poll there and I'll share the results with you. So I can see that regulatory requirements is really coming out as the top reason for many of you to be here today, which of course understandable. I know what we heard in the context from Majida earlier in the session, that mandatory reporting is now coming in Oman, so understandable, of course, that's a big focus. But I see a number of you also indicating that investor interest is a particular priority, and a smaller number of you as well also mentioning maybe sharing your own organization's reporting and goals, and maybe meeting the expectations of your peers in the sector as being relevant as well. So a really interesting mix, but I think fits the pattern we see in many markets where regulation and investors are often some of the key aspects in consideration there. Great, so I've entered that poll. Sometimes it does still appear on your screen, so just to say to close the poll window if it's still visible for you. But moving on in the presentation itself, I'm going to talk a little bit here now about some of these drivers. So we mentioned investors there, and maybe investor interest being a driver for some of you. And I think this is a common theme we're seeing globally. So in this data we have here, we see that more than 5,000 investors representing more than 128 trillion US dollars in assets under management are now signatories to the Principles for Responsible Investment. So it's fair to say in recent years, we've seen a big increase in the number of investors taking interest in these topics. And so what is it that's really driving that? So what I think is important to highlight here is that a key driver behind this demand from investors is the financial effect of sustainability risks and opportunities. So here we're seeing a study of retail investors, which was carried out by Morgan Stanley. And they found in the study that the top driver of at least individual investors that was driving their interest in sustainable investing was indeed the financial performance of sustainability risks and opportunities. So you can take a little bit of a look in the study in the handout if you like to follow the link that's there. But it's really just to say that, investors are interested in these factors for financial reasons, not just necessarily as a nice to have or an impact focused aspect. So we started to touch on financial performance and effects on financial performance there. So let's just say a little bit about what we mean by those terms. So it's important to say today in this training, we're going to be talking about disclosing financially material sustainability related information. So whilst we're going to talk later in the workshop about what the word material means, we wanted to be clear from the start about what sorts of financial effects investors are looking to have information on here. So starting with the effect on a company's performance, we often see this in the statement of profit or loss, so showing income or revenue and expenditure. And sustainability related risks and opportunities can have a financial effect by potentially changing the revenue mix or total revenue of a company. For example, if demand for its products and services change, or perhaps its production capacity is disrupted. And we can also see substantial changes in expenditures if, for example, operating costs increase due to energy prices increasing, or if there's a need for greater R&D expenditures to capitalise on sustainability-related opportunities. Or perhaps there's also other potential costs that could be seen associated with deploying new practices. You'll also hear us talk today about effects on a company's financial position. So we'll also look now at what that means. So we often see a company's financial position on their balance sheet, known as a statement of financial position. So for example, a company might experience changes to certain assets or liabilities due to climate or sustainability issues. We could potentially see changes in portfolio value, or we might even see write-offs of certain assets that are damaged or need to be repriced. And another financial effect that should be documented is changes to financing and the costs of capital. And so that can include, for example, increasing insurance premiums due to climate risks, or potentially making use of new financial structures, such as green bonds or social bonds. And another important aspect I want to highlight before we move into the next module is two really important aspects of sustainability-related risks and opportunities, which are really essential to our understanding of them and our disclosures. So firstly, we'll be talking about time. And as you can see here from the latest Global Risk Perception Survey from the World Economic Forum, risks evolve over time. So something that might be front of mind today as a near-term risk might not be what would pose the most significant risk 10 years from now. So what's quite important for our disclosures here is that we're preparing for those risks that we're expecting to arrive 5 or 10 years from now. And potentially if we're doing so and we're disclosing those, we might have to invest today in new practices or processes that would mitigate negative impacts and increases our chances of having positive impacts in the future as well. So what that might mean is that the financial effects that we were just talking about could occur earlier in time as a result of needing to take action now to manage these risks. And another important aspect of sustainability-related and climate-related risks and opportunities is their interconnectivity. So this is another visual from that same report from WEF, and as you can see here, there are many connections between different risks. So while many people might think of the two ISSB standards S1 and S2 as separate standards, maybe one for climate and one for other sustainability topics, however, as you can see on this slide, all sustainability-related risks and opportunities are interconnected. And so separating out one topic or theme, of course, doesn't remove these connections. And we still have to try to consider the whole when we're making strategic decisions. And similarly, the way that we deal with these risks and opportunities needs to be interconnected as well. So really, this is just to say that when we're disclosing information about climate-related risks and opportunities under the IFRS S2 standard, you also need to think about applying the requirements of IFRS S1 relating to other sustainability risks and opportunities, insofar as they connect to what you're talking about in the climate reporting. Okay, so that was just a few kind of important concepts we wanted to establish in the introduction and really explain the purpose, as I said, and drivers for reporting. I'll hand over to Lois now, who's going to get us started with talking about the reporting landscape. Thanks, Lois.
Thank you, Fiona, and hello, everybody. So we've covered briefly why sustainability disclosure is important and why the standards have been developed because of the risk landscape and investor interest. So now we're going to look at the development of the standards themselves. But before we do, just going to ask another Zoom poll, please, to establish what frameworks you are currently using for sustainability disclosure. So you can pick all choices that apply to you. Are you responding to CDP, formerly the Carbon Disclosure Project, using the Global Reporting Initiative standards, using the Integrated Reporting Framework, the Sustainability Accounting Standards Board standards, the TCFD or Task Force on Climate-Related Financial Disclosure Recommendations, or the United Nations Global Compact principles, or something else? And if it's something else, please do tell us in the chat. Thank you very much for sharing with us the frameworks that you're currently using. I'm going to end the poll here and share the results with you. So you can see that the vast majority of participants in this training today are using the Global Reporting Initiative standards for their sustainability disclosure, followed by the SASB standards, which are sector specific, and others using a mix of the other frameworks. So thank you for sharing that. It's very useful for us to know. So let's have a look now at how the ISSB standards that we're discussing today came to be developed. Well, they're developed by the IFRS Foundation, which is a not-for-profit public interest organisation that was established to develop high-quality, understandable, enforceable, and globally accepted accounting and sustainability disclosure standards. At the bottom of the slide, you can see that the IFRS Foundation hosts two independent standard-setting boards. The International Accounting Standards Board, that was formed in 2001, sets financial, accounting and reporting standards that are in place in over 140 jurisdictions around the world. And the sister standard-setting board is the International Sustainability Standards Board, formed in 2021, released its first two standards, IFRS S1 and S2, we'll be talking about today, in 2023, following strong market demand for its establishment. Now, as these two independent standard-setting boards are within the same foundation, they work very closely together to ensure that their standards complement each other. And governance of the standard-setting boards is provided by trustees, who are in turn accountable to a monitoring board of public authorities. So how did the ISSB standards come to be? Well, here's a slide that shows us the evolution of these reporting standards. And I'm sure many of you will recognize the logos of the organizations on the screen. And although this looks like a rather confusing slide, it's actually designed as a picture of more simplification and harmonization within the sustainability reporting world. So many of the organizations whose logos you see here focus on developing standards and frameworks to meet the information needs of investors, except GRI, which offers information for a wider range of stakeholders. you'll see from the arrows that some of these organisations have actually been consolidated into the IFRS Foundation. So the three at the bottom, the Climate Disclosure Standards Board, Integrated Reporting Council and SASB, have all been consolidated into the IFRS Sustainability, and their work is reflected in the standards we're going to discuss today. The Task Force on Climate-Related Financial Disclosure has completed its work, and the work on climate disclosure has now been absorbed by the IFRS Foundation. And similarly, with the disclosure-specific materials of the Task Force on transition plans. CDP has aligned its climate questionnaire with IFRS S2 on climate disclosure, and the GRI and ISSB, as we'll see later, are committed to working together to jointly identify and align common disclosures. So as I said, this is a picture of more harmonisation and simplification. Let's do another Zoom poll now. Given what we've heard about the consolidation and harmonisation, what do we think is the answer to this question? Companies that disclose using the recommendations of the Task Force on Climate-Related Financial Disclosure automatically comply with the ISSB standards. Is this true or false? Give you a few more minutes to think about that. I'm going to, in the interest of time, end the poll and share the results. And as you can see, it's very close. About half of you think it's true, half think it's false, which is understandable. Actually, the answer is false. The TCFD recommendations have been incorporated into the ISSB standards, and companies that disclose using the TCFD recommendations will be a long way towards complying with the ISSB standards, but there are some differences between TCFD and ISSB we're going to look at in a moment. So you cannot assume that if you're a TCFD reporter, you automatically comply with the ISSB standards. So let's have a look at why this is. Well, as we said, TCFD finished its work in July 2023, and the ISSB has assumed responsibility for the TCFD's work. The document on the left shows you the comparison between IFRS S2 and the TCFD recommendations. And there are three types of differences. The first is that S2 just uses some different wording, but to capture the same information as the TCFD. Secondly, S2 requires more detailed information than TCFD. So, for example, more information about resilience, for example, the resilience of the company's business model to climate risk. And thirdly, S2 provides some additional requirements and guidance, and in particular on the use of sector-specific disclosures, which we're going to look at later. So the ISSB's main objective was to set a global baseline for sustainability disclosure that would provide a common language for sustainability information, and that common language would enable comparable and consistent sustainability disclosures across global capital markets. The Foundation is working with jurisdictions around the world as well as other stakeholders to achieve this. Now, just because it's a global baseline doesn't mean that regulators and stock exchanges cannot add their own additional sustainability disclosure building blocks to the global baseline. And what this means is that additional disclosures can request information that is jurisdiction specific or that responds to wider stakeholder information needs. So those building blocks could involve disclosures that go beyond the remit of the ISSB standards, such as GRI, the sort of information that GRI asks for, or as we've said already, jurisdiction-specific information. And taking this building block approach reduces the need to duplicate information because we have got this globally consistent baseline of disclosures, while still allowing companies to report additional information based on, for example, ISSB standards or the specific information needs of the jurisdiction in which you operate. So there's been global backing for this global standard and the global baseline. The baseline is set out in the ISSB standards introduced in June 2023. IOSCO, which is the Organization of Securities Commissions, has announced its endorsement of ISSB standards and encourages its 130 members around the world to incorporate ISSB standards into their regulatory frameworks. ISSB works with audit standard setters. So, for example, the International Auditing and Assurance Standards Board has a new assurance standard to complement sustainability disclosure. As we've said, the ISSB has a regulatory implementation program where it's working with jurisdictions around the world on adoption of ISSB standards. And of course, it's supporting activities like this one today to encourage market participants voluntarily to adopt the standards. So I'm going to hand over to our colleague Vanessa now from the ISSB, who's going to explain to us more about the ISSB standards.
Okay, thank you, Lewis. So moving on, as we have talked about the business case and the market case for the sustainability reporting, the evolution for the landscape. Sorry, I think I forgot to switch the slide. Yes, we've talked about the business case and the market case for the sustainability reporting, and the revolution for the landscape and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. Okay. As we start, it's important to know that there are some key terms that should be understood. You can find the definitions in your handout, but I wanted to briefly mention them here. First of all, we will be saying in the phrase sustainability with related financial information quite a lot. This can refer to a broader set of issues, include climate, nature, or biodiversity, human, social, or others. Sustainability related financial information is information about a company's sustainability related risk and opportunities that is useful to investors in making decisions about providing resources to the company. Sustainability-related risks and opportunities are those that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital, such as it could affect the company's perspectives. We will also often refer to general purpose financial reports, which includes a company's financial statements and management commentary. You might know that it as like a management report or a management review or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, and so we will use this generative phrase throughout. Anyone familiar with TCFD will recognize the same four core pillars or the contents for the ISSB standards. These are governance, strategy, risk management, and metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the four pillars today, and I encourage you to download the standards as part of your homework assignment to get to know more about it. Moving on, to all the prepared listening, let me start by saying, don't be afraid. Yes, there's a lot to understand, but you might be surprised that some of the details is similar. For all the accountants listening, you too will be relieved to see many of the conceptual foundations developed by the IASB in the ISSB standards. Let's start with IFRS S1. or to give it to full title, General Requirements for Disclosure of Sustainability-Related Financial Information. So IFRS S1 sets out general requirements for the contents and presentation of sustainability-related risk and opportunities. If you are familiar with TCFD, you will see the same architecture apply throughout the standards. S1 prepares to refer to and consider the applicability of the SASB standards and other sources of other guidance to identify sustainability-related risk and opportunities and identify material information. The SASB standards are recognized by industry, enable a company to identify disclosure topics and metrics applicable to its business model and operations. So finally, the standards can be used in conjunction with any accounting requirements. The scope of S1 is all sustainability topics, except for climate, which is covered by S2. The second standard, S2, focuses on climate disclosures, building on the same foundations of S1. For example, it is full of incorporating the recommendations of TCFD. And secondly, it sets out the requirements for a company to disclose material information about its climate-related risk and opportunities. And thirdly, it requires the disclosure for both in cross-industry and industry-specific information. So in terms of like climate-related risks, this include both physical and transition risk, which we will come back to it later. So other specific climate-related disclosures are required, for example, scenario analysis and GHG emissions. Preparers must also refer to and consider the applicability of this industry-specific guidance on implementing IFRS S2. As we've said today, this is organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. So moving on, S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risk and opportunities, the company must apply both IFRS S1 and IFRS S2. This is because IFRS S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for the investors. So IFRS S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. So next, let's consider some of the conceptual foundations that underpin the IFRS standards, which might be new to anyone without any accounting background. These concepts helps us to understand how best to disclose information in order to meet the requirements of the IFRS standards. So firstly, to start with, the companies must fairly present a complete set of sustainability-related risks and opportunities. And secondly, fair presentation also requires disclosures to be faithfully represented. To achieve this, companies also provide a complete, neutral, and accurate depiction of sustainability-related risk and opportunities. The reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. And fourthly, another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The IFRS standards require companies to clearly identify key connections, such as those between the risk and opportunities, connections between the four pillars, and the connections between sustainability-related financial disclosures and the main financial statements. So now let me hand over to Lewis for the example.
Yes, thank you, Vanessa. And as this is our first example today, I just wanted to remind everybody of the disclaimer that Fiona gave at the beginning of the presentation, that all the examples we share with you today are designed to inspire and inform. They are not designed to represent our best practice. Some of the examples were actually prepared before the ISSB standards were issued, but we hope you find them useful. So this first example is from the annual report of a company called BHP, which is a mining and metals company. And it's part of the disclosure on how the company manages climate-related risks and plans to transition to a net zero economy. So this example in particular is used to illustrate how a company makes disclosures that show connections between different things. So what do we see being connected in this extract? The first paragraph tells us that the company's climate risk assessments and scenario analyses are integrated into and therefore connected with the company's overall strategy and treated as a sensitivity in their capital allocation process. So we see connections and alignment between the company's capital allocation plans, their strategy, and the climate risks they've identified in the scenario analysis that they have undertaken. Some assessments that they are undertaking are still in progress. So the company's undertaking studies, they tell us in the second paragraph, to assess the effect of future climate-related physical risks on the company's operations, productivities, and costs. So when they get those results, they will be used to inform and therefore connect with the company's overall risk management process, including their new risk management activities. Then thirdly, in the light grey text, the company shows connections to further information about the impacts of climate-related risks on their operational activities, greenhouse gas emissions across the value chain, financial statements, and production revenue and expenditure. So in this small extract, we can see evidence of the connections that the company is making between climate change, risks, scenario analyses, and its overall processes, including risk management strategy and capital allocation. So I'll hand back to you now, Vanessa. I think we're going on to another Zoom poll now, actually. So maybe I'll just start this while we're waiting for Vanessa. So on the subject of connectivity, this Zoom poll asks, what information should be considered for connected information? Should we make connections between governance strategy, risk management and metrics and targets, sustainability-related financial disclosures and financial statements, and sustainability-related risks and opportunities? What should be connected? I'll hand back to you after this Zoom poll, Vanessa.
Sorry, like my mute button just stuck.
It's all right. Happens. We'll give
Maybe
everyone a moment to think about
later
this.
I can get it back. Could you? Sorry.
Yes, take us. You take us through the results of the Zoom poll then, Vanessa, and I'll hand back to you.
Okay.
Okay.
Okay, as we like for this Zoom poll, like we discuss like what kind of should be considered for the connected information. So we have 3 options here, and then because now I can see like the zooming poll now. So let's stop here to see. Okay. So sorry. Still sorting out the. So actually like all are correct. So I can see most of you got the similar answers. Okay, great. Thank you. Sorry for IT connections here. Okay, moving on. Moving on, finally, the standards are built on the concept of materiality, so as defined by the IFRS Foundation. So we are going to go into this in a more detail later, but just to highlight that we will be referring today to material information, which is information that is, if omitted, misstated, or skipped, could reasonably be expected to affect investor decision making. During the ISSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and applications guidance published in 2023, a number of educational materials were also published, and since the others have followed, including the IFRS Knowledge Hub, and we are also in the process of gathering examples and case studies provided by our partners. The SASB standards were aligned with IFRS S2 to help prepare seeking industry-based guidance, and the FSA credential was also updated with more planned to come. So I should also note that the IFRS Foundation's capacity building program launched at COP27 is a key part of our support to preparers, and the SSE training initiative is one of the most important deliverables. So let's move to another sample. So for this sample, we will try to test you. So water is vital inputs to your business, but the ISSB standards do not currently have a specific standard on water. So what do you do? So this is a single choice question. So firstly, you do not disclose anything about water. And secondly, consult the sources of guidance listed by ISSB. And C, engage in consultancy to help. And D, copy your competitors' reporting. So let's see. Yes. I can't gradually see the sample. Can Fiona help me to stop the sample? Yes. Thank you. Great. Happy to see that actually, yeah, the correct answer is B. So I'm glad that most of you got it correctly. So for this, although C and D may also be helpful, but we will consider to consult the sources of guidance listed by the ISSB. Okay, moving on. Let me hand over back to Fiona for the summary. Thank you.
Great, thank you so much, Vanessa. So as Vanessa says, that brings us to the end now of our first full module. So congratulations. So I'll just run through a bit of a recap now on some of the key things that we've covered before we go back to Menti for a quick wrap-up exercise. So firstly, in this module, we reviewed the purpose of sustainability-related disclosures. And I think a key takeaway we hope that you'll leave this workshop with is that there are important benefits, both internally and externally, for collecting, disclosing, and preparing sustainability-related information. So if you're not aiming to make good use of this data that you're collecting to improve your organization's strategic decision-making, you're ultimately going about this wrong, and you're potentially wasting time and opportunity. Of course, if you have operations as well in difficult to abate or high impact sectors, your competitors may well already be disclosing risks and identifying opportunities that they're pursuing. And so that's going to eventually leave your investors wondering why you're lagging behind and might start to affect your ability to raise capital. And next, we looked at the evolution of disclosure standards and the formation of the ISSB with the aim to simplify the reporting landscape. And so when you're thinking about other voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but rather building on top of them. And finally, we introduce the standards and the important concepts that you're going to need in order to use the standards correctly. And a key point I want to reiterate here is that these standards and the guidance that come with them are designed to meet the needs of investors, and therefore they're heavily focused on those prospects relating to financial performance, financial effects and position that we discussed at the very start of this unit. Okay, so that brings us into our wrap-up Menti exercise, as I said. So just to explain, at the end of each module, we'll do a Menti exercise, and these also correspond to the aspects of the disclosure plan that we have set out in the homework assignment. So the intention here is just to get you thinking a little bit in each exercise, but if you'd like to expand your thinking on these topics, you can also do so by following the homework exercise as well. So our first question is really thinking about defining the objectives for sustainability reporting. So I think, as we've said, obviously there's a lot of different drivers here. And so it's really important to be clear on the goals for your reporting plan. So what are you trying to achieve through sustainability disclosures? And what requirements are you looking to meet? So this could be obviously alignment to the IFRS standards. It could be meeting particular regulatory requirements in your market, or perhaps the needs of particular stakeholders. And so really we just want to reflect here on what your overall objective is with reporting, and maybe what is the the level of ambition needed to change from your current status to get to that point that you want to achieve. So if we go back into Menti, which I see lots of you are already doing, if you can follow the links we've shared in the chat, and I'll share my screen now, our reflection question is just to get you to think really about what your objectives are. So you may, of course, not have these fully formed at the moment, but we find it's helpful just to reflect while we're here together on what we're hearing and get a sense from everyone really about what's front of mind for you as, the key objectives that you want to achieve here. Okay, I'll just give everyone another moment to respond to that, but I see lots of good answers already coming through that we can talk through together. So I see we've got a mention here of meeting the mandatory disclosure requirements and also investor interest and also managing risks. So I think that's a good three-way approach to thinking both internally and externally about this. I then see we've got mention of maybe getting the best possible results for the company. So thinking about, how you can derive benefit from these things is a great starting point. And then we have regulatory requirements and complying with IFRS, thinking about regulatory compliance again, I see, and several people have mentioned about achieving sustainability objectives as well. Fair reporting in accordance with baseline. So I think fairness and transparency are some other key words I see here. Just have a little scroll and see what else we've got. Lots of good answers. Thank you everyone for taking the time to engage with this. It's always great when we get lots of thoughts and interaction, lots of good ideas coming through. Ensuring transparency and accountability, and also thinking about the impact. So balancing those different perspectives. Transparency with your stakeholders, maybe attracting new investors is a good point to mention as well. So actually transparency and impact on sustainability and management might be important there for your investors too. Aligning with global standards, building stakeholder trust, decision useful information that's aligned to the global baseline. Yes, excellent. No, great great thoughts here. I think lots of really well-considered answers that demonstrate a good balanced consideration of both the internal benefits that you can derive here and also, the external drivers and imperative to do this. So I think lots of you setting out with a good, clear objective here to balance those two requirements. And, I think when you're working with your colleagues internally, always really important to continue to be clear on these goals and what you're trying to achieve to provide that clarity for them as well. See if we've got anything different. So I see we've mentions of elevated market presence and enhanced brand reputation. So maybe speaking a bit about actually the market opportunity that comes from better sustainability positioning as well over time and meeting new needs and requirements there. So also national level regulations, operational efficiency and resource management, business resilience. Okay, more and more great answers. So thank you everyone for these. Meeting the MSX mandate, of course, is a very good thing to keep in mind, and I'm sure that MSX will be happy to hear that mentioned. Getting more collaboration, maybe thinking about project deals, and yeah, overall good. Someone's mentioned as well. It's good to not lose sight of that, although we're using a financial lens here and thinking very much about the investor audience. That doesn't mean that we can't also achieve good things at the same time. So a nice balance to strike. Okay. Excellent. Well done, everyone. Thank you for taking part in that. So I will go back to sharing my other screen now. I think really you've highlighted there everything that we would have recommended. I'll just check to see if anything that I would probably say. I think maybe the only other points that we highlight is thinking about the future as well. And so thinking in these goals about how you can try to build a plan that's flexible to how future reporting requirements might develop. So great to ensure that we're compliant with what's in place today, but thinking about what the horizon might be in the future that we need to align to as well. But I think, really that aim that a lot of you have to balance meeting the needs of stakeholder audiences with maximizing the internal benefits at outset is a really good balance. But I'll close off the exercise there and take us back to the slides, and then I'll hand back over to Vanessa, who'll start us on the next session. Thanks, Vanessa.
Thank you, Fiona. So now that we have introduced like the initial concepts in our model 1, so let's dive into how to actually apply the ISSB standards and taking into account additional disclosures, including any relevant geographical or sectoral requirements, such as PA practices and your leadership's objectives. In order to understand how to ensure your disclosures meet the global standards, we will look at 2 key concepts in this unit. First of all, and the main focus of this unit will be on how to apply the standards to achieve a global baseline of disclosure. And once we cover that, we will also discuss how additional disclosures fit. To begin with, let's focus firstly on how to apply the ISSB standards as the global baseline. Let's get started. The first core contents, good governance. This includes aspects that will relate to the governance body in your company and how management is applied. For each of the core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosures requirements, for example, as part of a gap analysis. So if we look at the governance and management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and management for the processes, controls and procedures of sustainability-related risks and opportunities. For example, is management responsibility delegated to a specific role or committee? Do you have like a specific sustainability committee? And how and often do they get informed about sustainability-related risk and on opportunities? Is it like during like a quarterly, a year, or half a year? So how these issues informs the strategy, decision making, and risk management. This could include setting targets to manage sustainability-related risk and opportunities. And lastly, whether progress against these targets links to the executive KPI. For more information, you can make use of the SSE checklist too. But remember, it's not a replacement for reading and using the full ISSB standards. So let's take a look for more example and to see what we mean in practice. So let me hand over to Lewis for examples.
Thank you, Vanessa. And the first example we're going to look at regarding governance is from a company called Yara from their 2024 integrated report. And Yara is a global crop nutrition company with 17,000 employees in 60 countries. So a very big company. And this governance model shows us that Yara has a very highly integrated governance model with responsibilities for sustainability embedded across various relevant business functions. And you see these in the middle of the screen in the pale green boxes. So you can see that sustainability governance is embedded across human resources, ethics and compliance, climate and energy, corporate affairs, health and safety, and so on. And the sustainability governance team in the first box there, they have a direct reporting line to the chief financial officer, and their responsibilities are for sustainability performance and reporting and for sustainability risk management. You can see arrows are used to indicate the flow of information and input between the different governance bodies, and also to indicate where there is an oversight of a function, where there's a reporting line, and where there are available competencies to support the governance activities. So quite one last thing to mention at the bottom of the screen, you'll see that the sustainability governance team are also supported by a cross-functional sustainability network. So a very integrated model we see with Yara. Of course, the standards do not prescribe the governance model that your company should have. That is for the company to decide. There are lots of different structures. And let's look at another example now from Toyota, which I'm sure you all know is a car manufacturer. It's from their 2024 annual report, and it explains the role of their sustainability committee within the company's overall governance structure. So the Sustainability Committee is one of the business execution committees that reports direct to the president and the board of directors. So as Vanessa mentioned, one of the things that is requested for disclosure in the standards is about the frequency with which sustainability those charged with responsibility for governance of sustainability meet. And we can see here that this committee meets generally once a year or as necessary. So we know the frequency. This committee reports to the executive in charge of enterprise risk and compliance management. So quite different to the Yara example we looked at, where the reporting line was to the CFO. Just shows you the difference in models between companies on governance. We can see with the list of the members that, again, like Yara, these are cross-functional, coming from HR, accounting, environment, technical executives, audit and supervisory board members, and external experts. And finally, in the final row, we can see the actions taken by the Sustainability Committee to approve action plans on sustainability, as well as targets, materiality assessments, and to evaluate activity results. They determine the direction of the approach to sustainability, ensuring that it captures the opinions of stakeholders and social trends. And they revise the sustainability policy. And in the report, you can see that there's a QR code which enables readers to go direct to that sustainability policy. So with those two examples on governance, I'm going to hand over to Fiona to take us through the next section.
Great, thank you, Lois. So hopefully those examples have helped to make governance a bit clearer. And we're going to be looking in the next core content area now at strategy. So strategy does have quite a few more disclosures to include than governance, but it's also really where companies can see the benefits from sustainability related opportunities and being prepared for the risks. So as you can see here, there are 3 high-level areas that we focus on in the strategy content area. And these are risks and opportunities, effects, and resilience. So we'll review each of these separately now. So IFRS S1 and S2 disclosure requirements on strategy are designed to enable users of general purpose financial reports to understand a company's strategy for managing sustainability related risks and opportunities. And so if we first look at the requirements related to sustainability risks and opportunities, these are some of the questions that you'll want to be asking internally. So when disclosing information about risks, information required includes a description of the effects, the time horizons under which those effects are expected, keeping in mind here that the financial effects can occur either before the risk or opportunity materializes, or after or change over time. As we talked about earlier in the session, time horizons can differ somewhat for sustainability risks relative to other topics. And the last two questions on this list in particular look at climate. So this aligns with the requirements from the S2 standard. So for example, investors also want to understand what types of risks and opportunities have been assessed. And here we often see companies use the categories that have been identified by the TCFD. So this is physical and transition risk. And both standards include guidance here to support companies to identify and disclose sustainability risks and opportunities. For example, by using industry-based guidance and the SASB standards. Again, I know this can often be easier to look at in practice with an example, so we'll add a bit of colour here with an example of some practice. So here our example comes from Mondi Group's integrated report. So Mondi is an international packaging and paper company with operations across Europe, North America and Africa. And in the left-hand extract, we can see which risks the company has identified and how these risks align with four key categories. So that's strategy, financial, operational, and compliance. They also show the delegated risk owners, and there's a lot more information describing each of these risks within the report itself. And climate change risks, which sit in their strategic risk category, are then further analysed in the second extract and are categorised as both physical and transition risk and as well opportunities as well. And alongside identifying the risks through an evaluation process, which they describe in the report, Mondi also shows the estimated financial impact ranges, the time horizons for the risks, including a differentiation between the onset and the full impact of the risk and opportunity, and the sensitivity of the risks and opportunities in terms of their likelihood under different climate scenarios. So a helpful way of just showing how you can indicate and summarise your risks in a clear format. We started to touch on there a few of the other key concepts that are going to be important in the risk topic area with that example. And another of those aspects is about time and what we discussed at the beginning of the session. So you might remember when I introduced this earlier that time factor is something that can be quite different when we're talking about sustainability related disclosures. So let's be clear on what we mean by time horizons. So the standards ask you to identify within what time horizon any material effects are expected to occur. And the definitions that are used for short, medium and long-term time horizons can vary between companies, and they'll depend on a number of different factors. So for example, they may depend on investment and business planning cycles, on strategic planning horizons, on the life of the assets the company operates, or even other factors as well. So what's important to remember is that the time horizon should be defined. So don't expect that your investors will necessarily know what you mean by short and medium term. You need to provide a quantitative definition that makes sense for your company for that. And so what's important to remember is that the time horizon aspect is also another element that comes alongside the second group of disclosures. So the first section of the strategy component there was about identifying the risks and opportunities that could be reasonably expected to affect the company's prospects. This next set of disclosures then thinks about exactly what the effect is of these risks and where it occurs in the business. So to start tackling the disclosure requirements here, companies will want to ask themselves questions such as beginning to describe what the effects of the risks and opportunities are and understanding their responses that they have planned for mitigating or adapting to the effects. And again, we know an example may be helpful to show what this could look like in practice. So this example here comes from the global chemical producer BASF in their latest annual report. And it illustrates some of the projects that form part of the company's sustainability strategy. And so here we're using this example to show how they've explained how different sustainability risks and opportunities will affect their business model and the different aspects of their value chain. And within their overall strategy, they include supplying customers with products that contribute to sustainability through the use or through reduction of carbon footprints. And the company's prioritizing areas where they can see rising demand from customers and a willingness to pay more for sustainable products. And they also have a number of transformation products that they're implementing to support their company's license to operate. And among other things, the company's also investing in renewable energies to operate their plants, which you can see in the own production pillar of the extract there. And in the right-hand side, they refer to the triple S part of their operations, which is their Sustainable Solutions Steering Group, which is intended to streamline the company's portfolio and to support their global sustainability targets. And in the commentary that they have alongside this disclosure, they also say that they want to achieve 10 billion euros in sales revenue by 2030 from products that contribute to the transformation and transition to a circular economy. So overall, this example illustrates how the company's sustainability strategy is affecting its business model and its value chain. And connections are made between the company's strategy, between its sustainability targets, its technology investments, and its financial estimates as well. So shows how they are sort of connecting and demonstrating the potential positive and negative effects from the sustainability risks and opportunities. So sometimes one of the obstacles we know that companies face when they're reporting on these effects is what detail needs to be disclosed. And in the example that we just looked at there, we were showing mostly qualitative disclosures and descriptions. But what about quantitative information? So a company is required to disclose both quantitative and qualitative information about current and anticipated financial effects from sustainability risks and opportunities. However, the IFRS standards do set out a number of criteria for when only qualitative information is required. So this could be the case if a company cannot separate the effects of a climate-related risk or opportunity from other effects, or if there is a high level of measurement uncertainty pertaining to those effects. And finally, if a company doesn't have the skills, capabilities, or resources to provide that quantitative information. So overall, the intention is to provide quantitative disclosures where possible, but there is an allowance within the standards for either a mix of quantitative and qualitative information or purely qualitative information if those criteria that we've just mentioned there are met. So that brings us on now to the last part of the strategy component. So firstly, we looked at what the risks and opportunities are. We then talked about how they're going to affect the company. And then this final segment is really around how the company is preparing for uncertainties and ensuring its resilience into the future. And so this really gets into the practices and processes that the company has in place to assess its own resilience and to make strategic adjustments where needed. So disclosures required here include information on the types of assessment that have been used and how scenario analysis in particular has been utilised. So at its heart, resilience disclosure requirements are asking the company to say how it's assessed its resilience to climate change and what the key inputs and assumptions are that they've done as part of this analysis. So we'll dig deeper into this with an example, but some questions that you can consider asking internally to start the thinking on this will be focused on thinking about the company's capacity to react or adjust to uncertainties and how different scenarios might help you to better understand this. So again, let's have a look at another couple of examples. So our first example here is from Stora Enso, which is a Finnish and Swedish forest products company. And in these diagrams here, they're sort of really showing the integration of sustainability as a growth driver for their business and how they're projecting that will impact their business out to 2030. So in the top extract, they show the sort of different growth and value drivers that they've identified. So whereas their core business in the middle relates to forests, pulp, and kind of traditional products, they're actually seeing new opportunities to grow their business through sustainable buildings, renewable packaging, and through biomaterials. And then in the bottom half of the screen, they're actually showing how they're projecting their sales may grow as a proportion from these strategic growth areas. So whereas, as I said, historically, paper has been the bulk of their revenue, actually, by the time they look to 2030, they're projecting that these new growth areas will represent a much larger share of their business. So we don't have kind of quantitative financial figures here, but we do have an immediate picture of where growth is anticipated, and also, you know, an illustration of the company's long-term vision. And so this gives us a real sense of how they're targeting this growth. And alongside this, in the commentary, they speak around the work that they're doing to reposition their business and to really focus on acquiring other companies that will help them to achieve these growth areas, and also the investments that they're making now to convert their machinery and to innovate. So again, an example on how some of these financial effects are starting to be felt now, all about managing the future risks and capitalizing on future opportunities down the line. And our second example here is from Solvay, which is a Belgian multinational chemicals company. And so this example we're using in particular to illustrate how they report on the financial effects of their climate risks and opportunities. And so particularly I want to highlight that they're transparent in this disclosure about the estimates in their reporting. And they note that the estimates have been developed based on scenario analysis, which indeed is a useful tool when estimating anticipated financial effects. But, you know, there are other methods that can be used as well. But if you are going to use tools like scenario analysis, investors need to understand how you've used them. And so we can see in this excerpt that they note what assumptions they've used, which scenarios they've selected, which parts of the business they've assessed. And they also highlight the internal experts that worked together with the consultant to conduct the assessment. And then in the second part of the disclosure, in the table at the bottom, they then report on the financial impact drivers that they've identified for these risks and opportunities. And so they utilize a sort of qualitative scoring range from -3 to +3 to indicate the potential direction and magnitude of financial effect for the different transition risks they've identified. And they do that under both a 1.5 and a 3-degree scenario. So again, a useful way just to show the range of potential uncertainty associated with different pathways and how the financial effect may differ. So using a qualitative scoring scale like this could potentially be a good opportunity if some of those criteria that I mentioned earlier that would make providing quantitative information are difficult to meet. Okay, on that note, I've got a quick poll question to end the segment, and it's really just coming back to that point I mentioned about quantitative versus qualitative financial information, and just to test what you got from what I covered earlier. So the question for you is to let us know which are valid reasons why a company might choose to disclose only qualitative information and/or combined quantitative information about financial effects. So you can answer more than one option here if you think more than one is a correct reason, but these are the criteria that we touched on a little bit earlier. So we'll just test if you got what those were. So I'll give everyone a little bit longer to respond to this. We always like to get at least half of you taking part in the poll. So if you're not sure, don't worry, just feel free to have a guess and we'll let you know what the right answer is, because we know we've covered lots of different things so far. Okay. See the responses slowly coming in, which is good, steadily rising. Give it one more second and we'll end the poll there. Very good. Thanks, everyone. Okay, so it looks like the majority of people selected that the top answer was a right answer. maybe about half of you selected the second one and less the third. So the top two answers are both correct. So a company can choose to disclose qualitative or a mix of quantitative and qualitative if they can't separate out the effects of a climate risk or opportunity from other effects, or if there's a high level of measurement uncertainty. So both of the top two answers are valid, correct ones. As most of you spotted, the bottom option there, number 3, is not a correct answer. So, of course, it's important to be balanced and transparent in reporting. So, even if the financial effects are expected to be negative, if you have quantitative information about that, about material risks and opportunities, that does need to be reported. And we did see that in those examples that I showed you for scenario analysis there. So I think both Solvay and I think Mondi as well provided information on negative and positive financial impact. So it's important to share both in a transparent way with your investors. Lovely. Well, thanks everyone for that. And I'll hand back over now to Lois, who's going to take us through some climate-specific aspects for this section.
Thanks, Fiona. So S1 and S2 are actually very similar in their architecture and structure and some of their requirements. The governance requirements across S1 and S2 are very similar with no specific additional requirements for climate. However, when we come to the strategy component, the strategy requirements, there are additional requirements in S2 regarding climate. So we're going to have a quick look at those. Now, the title of this slide, From TCFD to ISSB, is really for reporters that have been using TCFD, but if you haven't, don't worry, because the list that we're going to go through here applies to anybody and everybody using IFRS S2. So S2 requires a company to refer to and consider the applicability of industry-based disclosure topics, and that's set out in the industry-based guidance on identifying climate-related risks and opportunities that you can access from the ISSB website. So this enables you to identify the type of industry-specific disclosure that you might make. S2 also requires information about where in the business model and value chain risks and opportunities are concentrated. So if, for example, there is a particular physical asset that is vulnerable to climate risk, or if there are parts of the value chain that are particularly vulnerable to disruption from sustainability-related risks. Thirdly, in describing the effects of climate-related risks and opportunities, S2 requires disclosure about how a company has responded to or plans to respond to the identified risks and opportunities. So what are the effects of the climate-related risks and opportunities on the business, and how does the business respond or plan to respond? And this might include setting climate-related targets or a climate-related transition plan. In providing disclosures about current and anticipated effects of the risks and opportunities on a company's financial position, financial performance and cash flows, S2 sets out criteria for when quantitative and qualitative information is required. So we've seen this earlier, that qualitative information is permitted only when a company can't separately identify the effects of the risk or opportunity from the effects of other risks, or when the level of measurement uncertainty is too high to make the information useful. Recognizing that some of these requirements are difficult to respond to, the standards allow companies, particularly in the case of anticipated financial effects, to use only all reasonable and supportable information available at the reporting date without undue cost and effort, and to use an approach that is commensurate with the company's circumstances. Then the penultimate bullet point here is about scenario analysis. Fiona's taken us through a few examples of this, but the thing to note about S2 is it does not specify the particular scenarios that companies must use for climate-related scenario analysis. That is for the company to decide. And finally, S2 requires additional information about the resilience of the business model to climate risk, including information to be disclosed on significant areas of uncertainty that have been considered by the company in its assessment of resilience, information about the company's capacity to adjust and adapt its strategy and business model over time, and also details of how and when the climate-related scenario analysis was conducted. I see someone in the chat has asked about whether we're having a break. Yes, we are, and it's coming up after the next 2 slides. So I just mentioned to you that one of the responses that a company can have to the effects of climate-related risks is to set a transition plan. So what is a transition plan? Well, it's an aspect of a company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy and might include GHG emissions reductions plans. Now, there's no requirement for the company to have a transition plan, but if it does, it must disclose details about it. So with transition plans, because they're part of a company's overall strategy, bear in mind that that transition plan should be aligned with the company's strategy, including the business case and motivation for the transition. And it should identify the levers that are most suited to the company in line with decarbonisation goals. Secondly, the transition plan should be aligned with science, including what science says about requirements for net zero to be achieved and how carbon neutrality or Paris-aligned goals are explained in terms of science. Of course, the transition plan should have long-term goals with clear mitigation and adaptation activities and targets to achieve those goals, as well as interim targets to monitor progress. The plan should be supported by information about what the plan is dependent upon for its success, what are the risks it faces, what challenges might occur in executing the transition plan, and how residual or unabated greenhouse gas emissions will be treated. The transition, of course, will be different for different sectors. It will proceed in different ways and along different pathways, and therefore it can be helpful to look at some sector-specific pathways that are set out by different organisations, and we'll have a look at some of those in a moment. And finally, the company should consider how transition plans will be evaluated by readers of the plan, by investors, and there are documents that set out the hallmarks of credibility of transition plans. Now, we're going to look at some resources now on the next slide, but just before we go into this, I just want to point out that on the 23rd of June, so this is very, very new, just last week, the IFRS Foundation published their new guidance entitled Disclosing Information about an Entity's Climate-Related Transition, and Fiona has given you the link to that guidance in the chat box. So that's very comprehensive guidance that can help you. What we're showing on this slide about transition plan resources is that this is only a small snapshot, but for example, the Glasgow Financial Alliance for Net Zero, you'll see 3 of their documents in the middle of the screen that set out expectations of real economy and financial institution actors on transition plans, but also some sectoral pathways. At the end of the screen, we see the transition Plan Task Force disclosure framework, responsibility for which has now been adopted by the ISSB, and you'll see that explained in their brand new guidance. But the point here is that the GFANS and TPT resources are designed to support the type of disclosure that is required in IFRS S2. There's also hot off the press as well, the Sustainable Stock Exchange model guidance on transition plans has also recently been issued, just last week actually, and Fiona's given us the link to that in the chat. So some of you have asked about the break, and you'll be pleased to know that it is now time for the break. I'm sorry it's only 5 minutes, but please do take this time to have a stretch, get a drink, and please remember to ask us any questions in the Q&A box. So we'll see you back here in 5 minutes. Hello everyone, and welcome back to the webinar. I hope you had an opportunity to have something to eat, a drink and a stretch. So we're returning now to our webinar. Before we start, I just wanted to say that we ended the first part of this webinar with information about transition plans, and you'll see that Robert has put in the chat a link to a webinar that's going to take place on transition plans. So please do have a look at that if you're interested. There will be a WBCSD representative talking about real life company experiences on transition planning, and also an ISSB board member. Right, so let's get back now to the next core content area of disclosure, which is about risk management. So this category of disclosure requires report preparers to disclose information about their processes for risk management and how they fit in with their overall risk profile. So the questions to evaluate and thinking about how you make these disclosures are to identify what processes and policies you're currently using to identify, assess, prioritize and monitor sustainability related risks and opportunities, remembering that the focus for sustainability disclosure is on those risks and opportunities that could reasonably be expected to affect a company's prospects. So when you're thinking about this, you also need to think about how the processes and policies that you use for risk and opportunity management and identification are integrated into the company's overall risk management process. Again, with risk management, there are some differences between IFRS S1 and S2. So we're going to look at the climate-specific considerations regarding risk management in IFRS S2 on climate disclosure. So the S2 requires more information than was the case with TCFD if you were using that, and in particular more detailed information about the input parameters that are used to identify risks, whether and how climate-related scenario analysis is used to inform risk identification, and whether risk management processes have changed. As we saw earlier, scenario analysis is to be used for assessing the company's resilience to climate risk, but the results of that analysis might also inform risk identification. And the same applies to opportunities. So what processes you have to assess, prioritize and monitor opportunities. So unlike some of the other requirements we've looked at that are really about the disclosure of information, the risk management requirements are about disclosure of the processes that are used for risk and opportunity identification and management. Let's look at some of the specific requirements on risk management in IFRS S2. So part of identifying risks, of course, is to be aware of what risks and opportunities you should be evaluating to begin with. And S2 does set out definitions of climate-related risks and opportunities, and these definitions are based on what was in the TCFD recommendations. So there are two types of risk. First, transition risk that arises from efforts to transition to a lower carbon economy. And these are often categorized as policy and legal, technological, market, and reputational risks. And we can see examples of these in the middle of the screen. So they might include increased pricing of GHG emissions, enhanced reporting obligations, exposure to litigation, costs associated with the transition to a lower emission technologies, changing customer behavior, uncertainty in market signals, and increased costs or availability of raw materials. The second type of climate-related risk that is defined in the standard is physical risks, and these include risks from climate change that can be acute, which are event driven from weather-related events such as storms, floods, droughts and heat waves, which are increasing in severity and frequency. It's even very hot here in the UK today. And also they can be chronic risks from longer term shifts in climatic patterns, such as changes in rainfall and temperature, sea level rise, reduced water availability, biodiversity loss, and changes in soil productivity. Now, at the end of the slide here, we see that all of these risks can give rise to financial implications for a company, such as costs arising from direct damage to assets or indirect effects of supply chain disruption. So the company's financial performance can also be affected by changes to resource availability and pricing, and perhaps even effects on employee health and safety. So in all cases, we have financial effects that can manifest in cash flows, access to finance, cost of capital, and of course these financial effects could manifest over different time horizons. Similarly, IFRS S2 sets out definitions of climate-related opportunities, which are the potential positive effects arising from climate change for a company. So, for example, these could be resource efficiency, energy source changes to lower emission sources, development of new goods and services to respond to different consumer demand for climate-aware products and services, and might also give access to new markets and enable the company to differentiate itself against competitors. And these opportunities, of course, also can affect the company's business resilience. And certainly opportunities are always of interest to investors who look at the opportunities that you have identified. And again, these opportunities give rise to financial effects, perhaps increased revenue from new product lines. So the financial effects manifest perhaps in the cash flows, access to finance, cost of capital, and again, manifest over different time horizons. Let's have a look at an example of a risk management disclosure. And this is from a company called the RS Group, which is a UK-based distributor of electrical and industrial equipment, and it has global operations. It's from their 2024 report. Now, the RS Group, they've analysed their climate-related risks and opportunities for a number of years, and elsewhere in the report, not in this extract, elsewhere, they identified 10 principal risks that affect their business, one of which is climate-related transition and physical risks to their business. This extract gives further information about the physical risks that they've identified. And the most significant financial risk relates to the impact of extreme risk on their distribution centres. You see that on the first line there. And the second main risk they identify here is the impact of extreme heat on extreme weather events to cause physical damage and disruption to their customer supply operations. You can see that this little red wheel in each line explains the connection between the risk and strategic actions, so supporting connectivity that we talked about earlier. And also you can see how each risk and opportunity connects to the stakeholders with which the company engages. In the extract, you can also see the description of the physical risk. You can see which business owner is responsible for the risk. You can see the metrics that are used to monitor the development of the risk and also to manage the development of the risk. And in the final column, the company tells us which activities they are undertaking to respond to the effects of the risk, including building upgrades and associated capital investments and business continuity planning. And you can also see that they have a focus on how these risks are going to be managed in future years too. So an interesting example of risk management there. I'm going to hand over now to Vanessa to take us through the next core content element.
Okay, thank you, Louis. So we are now moving on to the final and the fourth pillar of the standards, the metrics and the targets. So now we will now spend some time reviewing the disclosure requirements on the metrics and targets in more detail. Let's start with the metrics first. So the requirements on metrics are designed to enable investors to understand a company's performance in relation to its sustainability-related risks and opportunities. Preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, and as well as the methodology, such as what is the method of calculation and what were the inputs, and are there limitations and what assumptions are invoked. And now let's move on to the second part. On the second part of this category, the targets. So the requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals. The disclosures shall include, firstly, whether they are qualitative or quantitative, and whether it is set voluntarily or by law or regulation. And secondly, the metric used to set a target and to monitor progress towards its achievement. And thirdly, the baseline period from which progress is measured and the period to which the targets applied. And fourthly, what are the milestones and interim targets? And fourthly, if there have been any revisions to the targets together with an explanation about the revisions. And now let me hand over back to Louis for the example.
Thank you, Vanessa. So this example comes from the sustainability report of a company called CLP, which is one of the largest investor-owned power businesses in Asia Pacific, and it aims to be a leading responsible power provider. Now, this extract shows waste management and material use metrics for 2024. And you'll have noticed that many of the examples we've shared with you are about climate change, but S1 says that a company should disclose information about all of its sustainability related risks and opportunities. So here we see how the company is reporting on waste management and material use. So the metrics that this company has used to measure waste and material use come from SASB and from GRI. You can see that in the pale grey text in the first box under the title Waste Management and Material Use. And as some of you have asked about the alignment between GRI and ISSB standards, and we'll look at this a bit later, but it's fine to use SASB and GRI if you have metrics and information to report in addition to climate. So in this extract, the company is showing its progress towards targets that it set in 2021 and that it aims to achieve by 2025. And the targets are set out in narrative in the second panel on the slide here. And you can see that the company's results are shown in the bottom of the slide. So mostly they are in fact, in all cases, they are in line with their targets, except for waste products where they're slightly ahead. And all of these metrics and targets that they're giving are set within their strategy to reduce, reuse, replace, recycle, treat and dispose. So this is part of the company's circular economy strategy. So with that example, I hand back to you now, Vanessa. I think you might be on mute, Vanessa.
Okay, thank you, Louis. So now let's talk about some of the climate-specific considerations for disclosures on metrics and targets. Okay, it's not showing. Okay, could you hear me? Okay, now let's talk about, okay. It's okay, it's
Yeah, we
working.
hear
Yes, we
you
can
well,
hear you.
Vanessa.
Okay, thank you. So the TCFD framework include recommended disclosures, which IFRS S2 builds on an S2 as part of the required disclosures. For example, firstly, IFRS S2 requires disclosure of this industry-based metrics relevant to a company's business model and activities. And secondly, additional disclosures are required on GHG emissions, including separate disclosures for the accounting and associated joint ventures, and information about the company's financed emissions. In addition, IFRS S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While IFRS S2 does not implicitly require a company to disaggregate its GHG emissions disclosures by the constituents gas, IFRS S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I would like to remind everyone that you can access more information on climate metrics in the SSE's training tool on this topic, and we will share the link in the chat so you can find it on SSE's website. Likewise, there are some additional disclosures compared to TCFD and for targets as well. For example, oh, sorry, I think what's it? Requires disclosure.
Vanessa, apologies, you're breaking up slightly. I don't know if you want to try turning your video off and we'll see if that helps, but we'll just give it a second. Okay, perhaps we might have lost Vanessa temporarily, so not to worry. Let's just pick up from where she was. Oh, I see Lois is there. I don't know if you're able to jump in, Lois.
Yes, yes, can
Thank
do.
you.
Yes, looks like Vanessa's having some connection problems. So she was talking about the fact that there is a requirement for companies to disclose information about any targets that they've set, including whether they are in line with international agreements on climate change, such as the Paris Agreement, or they've been validated by a third party. There's the information about GHG emissions targets should include information about the planned use of any carbon credits to achieve the company's net GHG emissions targets. And also there are requirements to disclose information about the company's approach to setting and reviewing each target. So how it monitors progress towards the achievement of the target. And that might involve looking at sectoral decarbonisation approaches. So the next thing we're going to talk about is some more specifics on GHG emissions. And for those of you that are not familiar, GHG emissions are to be disclosed using different scopes. So scope 1 greenhouse gas emissions include all direct emissions that occur from sources owned or controlled by the company, including emissions from the company's facilities or vehicles. Scope 2 emissions are from the generation of acquired and consumed electricity, steam, heat and cooling, and include the electricity that the company purchases. Scope 3 emissions are all other indirect emissions that occur in the company's upstream and downstream value chain. So the information disclosed about greenhouse gas emissions should also include whether a company is using an internal carbon price for decision making, so that is for a company to decide, and whether climate considerations are inform whether and how executives are remunerated. Now, greenhouse gas emissions for the purposes of S2 are to be calculated using the Greenhouse Gas Protocol corporate standard, unless a jurisdiction requires a company to use a different approach to measurement. So we're going to look at an example now to see how a company called Enel, which is an Italian producer and distributor of electricity and gas, how they disclose greenhouse gas emissions. Now, this extract is from their GHG inventory. So they produce a separate report, a GHG inventory, and it starts with describing the company's overall ambition to achieve net zero emissions by 2040 and to promote energy generation from renewable sources. So again, this important connection between the metrics and the strategy. At the top of the slide, you can see the company's carbon footprint broken down by scope 1, 2, and 3. So with the dark blue graph bars, you can see the results for 2024, and then the shaded graph bars are for the 2022 base year. So you can see the trend across time, and you can see that that trend is one of falling GHG emissions across all of the scopes except scope 2 market-based that we'll discuss in a moment. And you can also see where the majority of greenhouse gas emissions are. They are from scope 3, which is indirect emissions apart from purchase of electricity. At the bottom of the slide, you can see an extract from the breakdown of scope 2 emissions. So when you report GHG emissions, they should be disaggregated or broken down so that the investors and other readers can see the source of the GHG emissions and the trends more easily. So they break down the scope 2 emissions by business activity in this part of the extract from power generation and other activities, including power distribution and real estate management. They also give us information about the scope 2 GHG emissions by source. So first from electricity consumption from the grid in power plants and electricity consumption from the grid in terminal ports and other locations. Again, they give us the breakdown by year, so we can see the 2024 and 2022 baseline comparison there. But they also break down by calculation method. Now, this only applies to scope 2, but scope 2 emissions can be calculated on a location-based method or a market-based method. The location-based method reflects average emissions intensity of the local electricity grid that the company is connected to, and the market-based calculation method reflects emissions from electricity based on the contractual terms that the company has entered into with the provider. So quite a lot of information about the GHG emissions, the trends, and the breakdown there. Let's have another Zoom poll now. And this Zoom poll asks, what is the objective of the metrics requirements in particular? Is the objective of asking information about metrics to enable report users to understand the company's performance in relation to sustainability-related risks and opportunities, to understand progress towards any targets, and/or to understand the company's assumptions about the future? Give you a minute to think about that. And thank you to all of you for participating. I'll end the poll and share the results. Yes, the majority of you are correct. The correct answers are A and B. And The reason for asking you this question this way is to draw your attention to the fact that at the start of each of the core components, the standards set out the objective of the information requirements. So in the case of metrics in S1, we see the objective is set out in paragraph 45, and the objective is to help users understand the company's performance in relation to sustainability related risks and opportunities, and to understand progress against targets. Now, of course, the metrics might also help the reader to understand the company's assumptions for the future, and in that sense, those of you that answered C are correct. But we ask you this question to draw your attention to the fact that there are very specific objectives set out at the beginning of each core component in the standard for the information requirements. So if you're struggling to work out what to disclose, have a look at the objectives of each requirement, because that might help you to decide what to report. So well done, most of you had that correct. We're going to move on now to the next part of the Align module, and this, now that we've covered all the core content areas of disclosures that meet ISSB standards, and this next component is about what if you want to or need to or have to report information in addition to the information required in the standards. So how do you build on the baseline? Well, you might want to do that because there are local requirements that ask you to disclose information beyond what we see in the S1 and S2. So these might take the form of listing requirements, for example. There might be policy objectives that mean that you want to disclose information in addition to the baseline. So this might be information about that can help you qualify for incentives like tax cuts or subsidies for sustainable practices that apply in the jurisdictions in which you operate. You might want to provide additional disclosures to align with emerging industry practices and to show how you're managing sector-specific sustainability-related risks and opportunities. Or you might want to build on the baseline because you want to provide information to a wider set of stakeholders than investors. Now, some of you have asked about the jurisdictional progress of adoption of ISSB standards, and as at just last week, the ISSB published a study showing that 36 jurisdictions have adopted, used, or are finalising the adoption of ISSB standards. So this was a major update issued on the 12th of June that you can find on the ISSB website. So these profiles that have been given by the ISSB complement the jurisdictional guidance that they have issued, and the ISSB is continuing to work with jurisdictions around the world who are considering whether and how to introduce sustainability disclosure requirements in line with ISSB. There's a regulatory implementation program and a roadmap development tool. And we can provide you with links about this too. So again, some of you have asked about this, about what if you are responding to GRI already, for example, what is the overlap? Well, the ISSB has formed strategic relationships with many organisations that already offer frameworks and standards on sustainability. We've already talked about the fact that CDP has aligned its climate standard with S2. The GHG protocol, which is to be used for the calculation of greenhouse gas emissions, the standard, as and when it is updated, the ISSB will be actively involved in that and also in the GHG protocol team's governance arrangements. We've talked about GRI and the fact that GRI and ISSB are working together to deliver full interoperability through identifying and aligning common disclosures. And I think there's been a very recent announcement, maybe Robert or Vanessa will put a link to it in the chat box, that the GRI will treat ISSB GHG emissions disclosures as equivalent to what is required for the GRI standards. We've already talked about the fact that the TPT's disclosure-specific materials have been adopted by the IFRS Foundation, and you'll find more about that in the recently released transition plan guidance. And similarly, ISSB is working closely with the Task Force on Nature-related financial disclosures to ensure that there is maximum interoperability between those standards and the ISSB's project on nature and biodiversity. I won't go into this slide in detail because we've already talked about the fact that GRI and IFRS Foundation are working together. This thumbnail you see on the left is a little document about interoperability on greenhouse gas emissions, but Robert has given us a link in the chat to much more recent news, very, very recent news about the fact that a GRI will regard ISSB disclosures on GHG emissions as equivalent with their own requirements. The two organisations are also collaborating on biodiversity, ecosystems and ecosystem services standards with ISSB looking at GRI 101. And on the governance side, the IFRS Foundation is a convening partner of GRI's Sustainability Innovation Lab in Singapore. Now, maybe not for this audience, but maybe some of you know that in Europe there is the Corporate Reporting Sustainability Directive. And again, the requirements in there, which as many of you know are under review, are similar in some respects to those in the ISSB standards. Again, an exercise was done a while ago to see how similar those requirements are, and in relation to climate-related disclosures, they found a high degree of alignment when the two organisations looked at them together. Of course, there are some differences because the European requirements, which are supported by European sustainability reporting standards, are designed to meet the information needs of a wide range of stakeholders. So they require information on impacts as well as risks or opportunities that affect a company's prospects. And the ISSB standards, they focus more on so-called financial materiality and hence the slight difference between the two. But as you know, this is under review at the moment. Similarly, on the interoperability side, you know that the integrated reporting framework was adopted into the ISSB, and the integrated reporting framework is regarded as a complementary tool for sustainability disclosure because it can support a more holistic view of the value creation process through governance and business model disclosures, especially that drive more connectivity between financial statements and sustainability related financial disclosures. Perhaps the most important thing to say about integrated reporting is that it's supported by integrated thinking, which can really enhance the quality of a company's corporate governance. But the main thing to note here is that we do have this document that's, we have a little picture of it on the left-hand side, which, if you're interested, gives you a guide to getting started on using integrated reporting to support your sustainability disclosure. Let's have another Zoom poll now before we move on. And the question is, my disclosure objectives should consider the ISSB standards only. I think you can only answer one here. It's a single choice question. So consider the ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above and other sources of guidance. I can see from how the progress is going that you will know the answer to this question. So because there's a clear pattern and in the interest of time, I'll share the results. Of course, you're absolutely right. It's D. Your disclosure objectives should consider the ISSB standards, regulatory requirements, and other sources of guidance. as we saw with the CLP example, and as we saw with the the section we've just had on the use and interoperability with different standards and frameworks. So thank you for participating in that. And I think we're handing on to Fiona now for the Module 2 summary.
Brilliant. Thank you, Lois. So, as we've said, that brings us to the end now of our second module. So, you'll be pleased to know we're well more than halfway through the training at the moment, but Module 1 and Module 2 are quite substantial ones. So, don't worry, we're not going to be here for another 2 hours. We've got another hour and 15 minutes, I think, for Modules 3 and 4. But to wrap up on Module 2, let's just take a minute to remind ourselves of what we've learned. So we reviewed all of the 4 core content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. And an important thing to remember is that these don't operate in silos. And we saw that in the examples that we discussed, that despite having those 4 separate categories of information, of course, all of this is inherently interconnected. And we also discussed how your disclosure might go beyond the requirements of S1 and S2. So, for example, to meet the needs of different stakeholders, to meet regulatory requirements in certain jurisdictions, or to meet industry standards as well. And what's important to remember when you're doing this is that the ISSB standards have been purposely developed to act as a baseline. And the building blocks approach then allows report preparers to add additional disclosures on top. But in doing so, also, you need to be careful not to obscure the requirements of S1 and S2. Okay, so in keeping with our last module, we're going to wrap up now with another quick exercise. So the exercise to wrap up this aligned section of the training is really to think about where you are now with your reporting and where you want to get to. So, of course, we'd recommend using the tools that we've mentioned, including the SC gap analysis tool, to help you to do a fuller gap analysis. So if you go to your homework exercise, there is a check sheet there that you can use to support you in doing this high-level gap assessment. But just to get the thinking started, we'll have a little reflection together now on what you think the immediate gaps are in your disclosures. So maybe you've identified some enhancements or new requirements in the S1 and S2 standards that would require you to do things a little differently than you have previously. Or maybe there are new topics, new processes or skill sets that you think you might need to allow you to adopt the standards. So lots of different issues, I'm sure, but just an opportunity to reflect on what's coming to mind for you as the most significant gaps that you see at this point in time. And I see we're getting lots of answers again already, so thanks everyone for taking part. I'll just share those so we can have a little bit of a look together. So let's see. So firstly, I can see alignment with the GRI reporting with IFRS reporting requirements. So yes, we know obviously when we ask companies which standards they're already using, that often the GRI will be the one that many organizations perhaps have already adopted. And, it's something that you now need to assess alongside your IFRS requirements. So we hope that the overview we've provided on the alignment there in the previous section that Lois covered and some of the resources on the mapping front can support you in better assessing that. So I see data collection coming up a few times here. So maybe inconsistencies in methods that might affect the reliability of metrics, the need to improve accuracy and perhaps track scope 3 emissions and set clearer KPIs and think about third-party verification. I think that is very common as an issue that we see mentioned here, that these requirements are bringing in a much higher level of quality requirements when it comes to the data front. So whilst many organizations might have started some data collection already on sustainability issues, there's a bit of a step change that's needed when we're starting to think about reporting these things in a financially connected way. So I think we'd really recommend if you're not the financial colleagues, engaging with your financial colleagues here to support you in setting up the right approach and processes to prepare things in the correct way there. And as much as you can, making sure that you're utilizing data that you already have in the business to support you here. So it might be that although this information is not being reported publicly, or maybe it's reported for other reasons, it can be utilized for sustainability. So for example, energy information relating to your emissions, or operational information on compliance, etc., that would inform your understanding of risks and opportunities. So I see several people mentioning similar issues. Someone also highlighted maybe the need to link risks and opportunities with strategy. Yes, for sure. Often perhaps these things have not been as connected in the past as they need to be. But as we saw in those different examples that we talked about, the companies that are really doing this very effectively are really making that connection in their strategy and their business model as to how these issues are affecting their business and the steps they're taking. Okay. Lots of different guidelines and disclosure requirements. Indeed, it can be quite a complex landscape to navigate. I think definitely looking towards your national regulations and what they implement is a really good starting point to make sure that you're aligning to those in the first instance, and then perhaps building those building blocks that we talked about of using the ISSB standards and your national regulations, and then thinking about any additional disclosures that you might add on top of those, but starting with that baseline first off. Okay, ChatGPT gave us an answer there, but we'll stick to what the humans think for now. So needing better stakeholder input and audit processes, maybe needing to think about materiality a bit better. Exactly, and I think those two connect well together as well. So seeking stakeholder views on materiality is certainly a key exercise here, and particularly your investor views for this IFRS S1 and S2 angle. So let's see if we've got anything else to highlight. Lots of really good responses. So I'll leave this screen on this question for a little bit longer so that we can all take a moment to read through these as well, since I think lots of useful thinking shared here. I hope it's helpful to see, that lots of other organisations are likely facing similar challenges to each other. And let's have a look as well. So needing to build internal capacity. I think that's often something we see mentioned as well. So, I think there's a combination approach here. So it's about, upskilling your employees that you already have who'll be working on this, and maybe considering, are there other needs that you'll need to procure as well to kind of build out your capabilities. But certainly, I think when we're talking about the S1 and S2 standards, they build very heavily on what's already in place in the accounting world. So I think bringing together those skill sets of your audit and financial reporting teams with the sustainability professionals that you have will hopefully help you get to the right blend of skills needed to take this forward. So very much forming that team internally who'll form a group to work on this together. Okay, and then people have mentioned maybe needing to integrate things into financial planning is a key challenge, or thinking about risk management as well. So indeed, often these things are not something that's going to happen overnight, that's for sure. So I think, starting with setting out, your initial principles and kind of a high level view on risks, taking that kind of information to your colleagues to discuss and consider what steps need to be taken to integrate is also very important. Great, thank you again, everyone, for lots of really good ideas. Sometimes we're sitting quietly waiting for answers to come in here, and it's always great for us when we have lots of good content coming through. So really appreciate it, and it's always good to share these things. Great. So getting the right governance processes, indeed, as well. We talked about that sort of foundation earlier on as something that's really important to have established early in the process, because actually, if you have the right governance, that can support you in then addressing a lot of these other gaps. And some people are mentioning particularly the climate side of things as also maybe being a new requirement, and something perhaps that will require new analysis and methods as well. So again, something hopefully some of what we talked about will help with. Okay, so lots of good ideas. I'll just pause and have a quick check, see if there's anything we've not mentioned already. I think there's been some common themes. Maybe that person here mentioning around target setting as well. Indeed, obviously, the disclosure requirements are very much focused on, disclosing the targets that you have. But if you're thinking long term about how you manage risks and opportunities, increasingly setting those targets is key. So, perhaps we're familiar with how to set a carbon target, or that's the one we're most familiar with, but then we're looking at risk management for other types of physical and transition risk. We may need to think a little bit differently about what's meaningful there. So would recommend looking to those sources of industry guidance that we've mentioned throughout for some ideas on that. And we'll share a few resources at the end that can support as well with understanding and navigating these things in different sectors. Brilliant. So lots of gaps, and I appreciate that does probably feel like we're reflecting on lots of work to do. But I think what we'd really recommend is to consider how you prioritize these issues. So some of these things might be quite significant to have in place prior to your first disclosures. For example, your governance arrangements, relationships with your financial and risk teams, etc., clarifying who's going to be involved. But some of these things might also be things that you can improve and evolve over time as your reporting matures. So thinking about what's important to tackle early in the process and maybe what you can build out as your disclosure plan and roadmap over time in terms of sequencing these things. So that's where we'd encourage you as well to take some of what we've started to discuss here through into that disclosure plan homework assignment, which will help you to think about this in a bit more detail. Okay, I'll stop there with the exercise, but as I said again, thanks everyone for sharing so many great thoughts, and I'll hand back over to Lois now, who'll start us on Module 3.
Thank you very much, Fiona. So we're now going to look at the implement module of this training, Module 3. And implementation is all about how to do practices that will support your disclosure. So as you know, the standards themselves really focus on what to disclose, but there is some information in them about how to, for example, identify risks and opportunities and to evaluate the things you'll need to make decisions about. So there are three aspects to this implement model as follows. The first one is about identifying sustainability related risks and opportunities. So how would one go about doing this? Well, first of all, IFRS S1 asks companies to provide material information about all sustainability related risks and opportunities that could reasonably be expected to affect a company's prospects. And S2 sets out specific requirements for climate related disclosure. But what about risks and opportunities beyond climate where there isn't yet a standard? S1 directs companies to sources of guidance to support their identification of risks and opportunities, and also to help them to decide which information to disclose about those risks and opportunities. So what does the standard say? It says, first, when identifying which risks and opportunities to report on beyond climate, S1 says that consideration must be given to the SASB standards. These are the sector-specific standards that can be found on the IFRS website. In addition, companies may consider other materials. There's IFRS educational material on identifying sustainability-related risks and opportunities and disclosing material information, and that's very comprehensive. Maybe Robert or Vanessa will give us a link to that educational material in the chat. So as we saw, do you remember from the CLP example where they were giving us information about their metrics and targets on waste management and the circular economy? They had actually done this. They had used SASB standards and GRI standards in order to identify and report on their waste management and circular economy risks and opportunities. And thank you, Fiona, for giving us the link to the IFRS educational material on this in the chat there. Having identified the risks and opportunities, the second column on this slide simply tells us that we refer to the same sources of guidance when deciding which information to disclose. But in addition, companies may also consider GRI standards and the European Sustainability Reporting Standards. Let's have a look now at an example, and this example comes from Ayala, and it explains how they identify risks. Ayala is a Philippines-based conglomerate. It's got lots of different industries within it, including banks, healthcare, and technology. And this extract shows how they go about identifying and reporting on risks. So first of all, they conduct communication and consultation exercises with a wide range of different stakeholders. And having done this consultation, they have inputs, insights, and recommendations on how to improve their process planning and strategy regarding sustainability related risks and opportunities. That communication and consultation informs each of the 4 steps they then take. First of all, they establish the context, the risk context in which they operate. They take account of internal and external factors. This is led by their enterprise risk management team. And from that, they establish their risk management goals and objectives, their policies and governance structure. The second step is to assess, identify, analyze, and evaluate the risk. So they will have from that process an idea of their risk universe, how they define the risks, and how it might affect their portfolio. Thirdly, they decide how to treat the risks. And fourth, they have a process for monitoring and reviewing the risks, and including how the monitoring and overview should be overseen. Let's have another example now, and this is from a company called Nest. It's an extract from their 2024 annual report, and Nest is based in Finland, and it's a leading producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. This extract comes from the climate section of their report, and it shows how they use scenario analysis to identify risks and opportunities over a time horizon till 2050. They use 2 different scenarios. The first is called the net zero world, which is where they anticipate rapid and radical emissions reductions to limit global warming to 1.5 degrees C. And they use specific scenarios to inform that. Now, they split that scenario over 2 regions. First of all, the world, and secondly, EU and North America directly underneath. And they do this because economies take action at a faster pace or a slower pace, and using different techniques. In both cases, the company anticipates opportunities from growing demand for the renewable and circular solutions that they offer. On a global basis, they can expand into new markets and sectors, and in the EU and North America, they expect their supply of renewable and circular solutions to be supported by regulation and voluntary ambitions. Of course, as well as the opportunities, they identify risks associated with competition and the acceleration of new technologies. The second scenario that they use to identify risk is the so-called compromised climate target scenario, where there is failure to take climate action, current trends continue, and global warming reaches 2.5 to 3 degrees C above pre-industrial levels. And in this case, again, the company sees opportunities to differentiate itself from competitors, but also some risks that the demand for their products is constrained in this compromised climate targets world. Now, in all cases, you can see in the bottom line, the company gives an indicative financial impact of these risks in different scenarios, and the most positive indicative financial impact is in net zero world 2050, which you might expect from a company that is developing sustainable solutions and circular economy designed products. So 2 examples of 2 companies and the process they go through and how they identify risks and what risks they identify. Now, we've mentioned this already, so I won't go into it in detail, but the standards recognise that identifying and reporting on risks and opportunities can be difficult. So the standards say that in identifying risks and opportunities, a company may use all reasonable and supportable information available to it at the reporting date without undue cost or effort. And we've come across this phrase before. But let's think about what reasonable and supportable means. Well, first of all, it's specific to the company. So not just general statements about sustainability risks, but will give specific information about the impacts on the actual company of these risks and opportunities. Secondly, it takes account of the external environment. And we saw this in the Ayala example where they'd conducted a consultation, but also in the first step of their process, they'd looked at external factors that inform the risk landscape. Thirdly, it includes information about past events and current conditions, of which the company will be aware, of course, but also takes account of forecasts, perhaps informed by scenarios, as we saw with the Nest example. And in some cases, what the company is to do is specified by the ISSB standards, and it will allow preparers to use an approach that is commensurate with their skills and capabilities. We're going to hand over to Fiona now for the next part of the implement module.
Great, thank you, Lois. So once we've identified those risks and opportunities, the company then needs to evaluate the financial effects of them. And so we know this can often be one of the most daunting aspects when first starting. So we're going to review here a few of the key concepts that can help to get started with this process. So to help investors understand a company's resilience to climate risks, S2 requires them to disclose information about the implications of climate change on its strategy and business model. It also asks for the company's financial and operational capacity to adjust or adapt over the short, medium, and long term. And for example, you might test your company's resilience against new regulation to limit certain high emissions activities, or your ability to respond to changing crop yields due to more frequent heat waves. So to do this, you'll need to use climate scenarios and analyse how they will lead to different effects for the companies. And it's important to remember that scenario analysis doesn't require you to predict the future. It's purely a tool to test your resilience against plausible potential future pathways or events. And S2 doesn't specify specific scenarios that companies should use, but it asks that they use relevant scenarios to provide disclosure about which scenarios have been selected and what the key assumptions are that have been used in the analysis. And it also provides guidance within S2 about a range of different practices that could be considered here. So starting perhaps with qualitative scenario analysis and then progressing down the scale towards more complex statistical methods. And overall, companies are asked to use an approach here that's commensurate with their circumstances and that uses all reasonable and supportable information that is available to the company at the reporting date without undue cost or effort. So again, let's have a little look at an example here. So here we're looking at a summary of the disclosure from Nestlé, the Swiss multinational food and drinks company. And this visual we have is one of the outputs from their climate scenario analysis, which shows the potential impact of physical climate change on the yield of 12 of their key agricultural commodities. And in this diagram, they're showing this projection out to 2040 based on an intermediate emissions scenario. And overall, what we're seeing is that they project some aspects of crop yield will decrease. In some areas, there might be a little bit of an increase, but overall, probably more crops are going to decrease, or maybe there's even an uncertainty range. as well, where it's uncertain how climate factors are going to change yields at present. And so this really shows that potentially there are some resilience concerns for them relating to the volatility of the costs of key raw ingredients that could then increase operating costs and prices. And so in their disclosure alongside this, they summarize how this impacts different areas of their business and the steps that they're taking to improve their resilience. So yeah, and one example that might be helpful to look at in the detail of the report to read up a bit more about how they've conducted this. And we do know, of course, that anticipating the potential materiality of future events can be very challenging. So to help with this determination, the S1 standard gives you a number of different issues, as shown on the screen here, that can help you to make this determination. So this is really a list that's intended to take you through the steps to come to this judgment of potential uncertainties. So, for example, you need to be considering both low probability events with high impact outcomes, as well as perhaps those higher probability things with lower impact, so both types of event. But overall, it's important to continue to evaluate and report any uncertainties relating to future cash flows and assess this each reporting period. Okay, I'll hand back over to Lois now for the next segment.
Thank you, Fiona. So we're moving on to the last part of the implement module, and this is about developing processes or integrating your sustainability disclosure considerations into existing processes. And when we did the last exercise at the end of the module, lots of you were talking about data collection and things like that. So when considering what systems and processes are needed for sustainability disclosure, the good news is that you're likely to have processes and systems already in place to assist with this. And the question is whether to use those processes as they are, or to develop something new, or to adjust what you already have. So on the page here, we see a list of things that management may consider when evaluating the suitability of existing systems, some of which have already come up in our exercises. So management might conduct a gap analysis to check for gaps in existing systems and processes. To consider whether existing processes are suitable for identifying sustainability-related risks and opportunities, including whether the criteria used for identification and assessment are suitable, or whether additional criteria are needed, such as vulnerability and speed of onset. The company's existing controls processes might be useful inputs for sustainability disclosure, but people, of course, are important. Which contributors, which departments already have expertise, systems and processes that could help with sustainability disclosure? Management might also need to consider the interconnections between all of these things and different internal and external factors that affect sustainability disclosure and the identification of risks and opportunities. Of course, in developing processes or considering how they apply, how will uncertainties be taken into account? An important part of the process that might not apply to other types of risks and opportunities the company deal with, just because of the particular characteristics of sustainability related risks and opportunities and the uncertain time horizons and effects over which they manifest. And finally, what resources are in place to develop existing systems or to produce new ones, and what is necessary to get those resources? Could be a budget process needs to be done. All of this links into using a disclosure plan, and those of you that have had a look or heard what we've said earlier will know that we are recommending that you develop a disclosure plan as part of your homework. And a disclosure plan can be a standalone strategy or part of a wider disclosure strategy that incorporates other types of disclosure your company might have to make. And it enables you to take control of your narrative. You'll notice that the requirements ask about your strategy, your risks and opportunities, your governance processes. And a disclosure plan makes sure that you are representing what your company does rather than making generic statements. A disclosure plan also supports internal collaboration across the departments that we've just described. So what knowledge needs to be shared, what processes and systems need to be shared, how can teams work together, what staff need to be involved, or even external consultants. So how does the disclosure plan help to coordinate all of the people that need to be involved? How will those individuals and departments be organized? What will be their responsibilities? How will data be sourced? Will you decide to get assurance for some or all of the disclosures? Who will provide the assurance? What are going to be the sign-off procedures? These are all the types of things that can be recorded in a disclosure plan, and in doing so, that creates a reference point, an audit trail, showing where and how judgments have been made, what decisions have been made, who's involved, and so on. I'm going to look at an example now from a company called Novo Nordisk that sets out, it's not their disclosure plan as such, but it sets out what the sorts of things you would find in a disclosure plan. And they call it the basis for preparation of the sustainability statement. And it's just an extract. So in this extract, we see that in preparing their sustainability statement, which regulations, standards, and practices the company has had to or has chosen to use for its disclosures. And in the second paragraph, we see a long list there, including the Science-Based Targets Initiative, the GRI, Danish Financial Statements Act sections, and so on. In this extract, we also see the approach and scope the company has used for data collection and verification of its reports, why and how changes have been made to their reporting since the last reporting cycle, including how errors have been corrected, the time horizons they consider for preparing information, and how they define short-term, medium-term, and long-term. They talk about how they've used estimates and where to find more information about assumptions that they've used and the uncertainties they've faced. And there's lots of other contextual information. And all of this helps readers to understand how information has been prepared, and certainly encourages trust and understanding in information. So let's have a look now at another Zoom poll. This is at the end of our implement module. And the question is a disclosure plan required by the IFRS sustainability disclosure standards? You can either answer yes, you must disclose your plan, or no, but it's a very helpful tool. So I'll give you a moment to think about that. Let's have a look now, in the interest of time, at what we're saying. So 57% of you said yes, and 43% said no. So you're a little bit split there, understandably. The correct answer is no. So well done to those of you that said no. There is nothing in the IFRS sustainability standards that says you must have a disclosure plan and you must disclose details about it. There are certain requirements, like with the GHG emissions requirements, that ask you to disclose the methodology that you have used for certain calculations, but there's no requirement to have an overall disclosure plan. We just recommend it for your optional homework because we think it's a very helpful tool for progressing your sustainability disclosure. So I'm going to suggest that we skip this next Zoom poll in the interest of time and that we hand over to Fiona for the Module 3 summary.
Thank you, Lois. Very good plan, I think. So to wrap up this module, we're going to remind ourselves of a few key things. So firstly, we'll come back to those connections. And in the last module, we highlighted the importance of connections between the 4 core content areas of disclosure. And then here we learned that there are also many connections as well between a company and its external and internal environment. And these are what we really need to focus on to identify risks and opportunities. The second thing we talked about was about evaluating risks and opportunities. And a key component here is about consistency and transparency in our assumptions. So, for example, using scenario analysis is a very helpful tool, but it's important to be transparent about how we've used it in our disclosures. And finally, as we've seen, even if some of this data maybe isn't data that you're already disclosing, it might be that you're already collecting it for other reasons. Or maybe you have appropriate practices in place that would allow you to start to collect it. So try not to start from scratch wherever possible and see what adjustments you might be able to make to get the data that you need. So to wrap up on that quickly, we're going to go into a quick exercise just to get you to reflect really on what you've heard so far about what's needed and any potential systems or processes that maybe you have in your own organizations already that could support you in collecting this data. So perhaps it's thinking about data you already have, or maybe processes that you could adapt or change, as I say, to help you to collect this. So let's just have a quick, do it just for a couple of minutes, but we'll have a quick look together at what your thoughts are on that and just get some ideas sparked, I think, about what might be available in different organizations. There may be some systems that are perhaps unique to your organization or sector, but some probably that are also common to others. So I know any ideas that are shared here are always helpful for other people on the training as well. Brilliant. Thank you for those who've already put responses in. This is great. So we have ERP and accounting systems, indeed, already tracking energy costs, resource logistics, and then, as this person's rightly suggested, you can then extrapolate and apply factors to be able to estimate carbon footprint, water usage, etc. from that. Someone's also mentioned about HR and workforce management, for example, gathering information that can support DEI reporting or employee health and safety and other training metrics. So adapting audits and compliance systems to collect more data efficiency, maybe also procurement and vendor management processes, indeed, to understand about ESG performance and risks in the value chain. Facilities management logs, also another source on the energy efficiency side and about equipment and sustainability initiatives at an operational level. So very good points highlighted here. Let's see what else we've got. Some people are mentioning about financial reporting again and risk management in particular. So indeed, using those existing risk management processes and tools to assess your ESG risks in a consistent way with other business risks. Someone's also mentioning maybe if you have environmental compliance requirements such as permitting, that might also be collecting data that could be supporting you here. Lots of good ideas here about customers as well, thinking about what stakeholder sentiment you're getting through from your customers about, maybe demand for new product types or where new opportunities may lie in terms of meeting customer demand or meeting their expectations as well, as it's highlighted. Okay, excellent. There's lots of really great suggestions here. Thank you, everyone. So in the interest of time, we'll move on, but I think that's a great reflection and really shows, I think, as you've all highlighted successfully, that there's a lot that you can really utilize that's already existing within your organizations to support you here. So I think just a few things we'd highlight to wrap this up is really about making sure that you have the right governance around these systems. So gathering the data from all of these platforms is one thing, but doing your best to sort of map out what the information flows are, who's responsible for each data, and how it contributes to your group reporting will be important to make sure that you can keep track of things. And I know Robert's going to talk a little bit more about some ideas in terms of reporting and technology now. So I'll pass over to Robert for our communicate module on that front.
Yes, lovely. Thank you very much, Fiona. Hello, everyone from very hot Frankfurt. As the whole Europe are going to have through the heat wave. All right. Yes, indeed, as Fiona mentioned, we'll be moving now to the last module of this training, communication, and we'll have then 3 units here: location and timing. We'll be talking about efficiency and confidence. So let's start. And the first we'll be then talking about the location and to clarify where the sustainability disclosure should be located in your financial report. But before we move to this to the section and talk about the details, let's step back and look at a bit bigger picture. So sustainability reporting is a part of the complete investor focus reporting package. So investors already get access to financial statements, and what the ISSB standards do is to complement those statements by identifying sustainability-related risks and opportunities that could affect the company's financial performance. And together, these form what we call a general purpose financial report, a full package that includes both financial and sustainability-related financial disclosures. And now you might be familiar with GRI standards, which cover broader societal impacts. So while GRI and ISSB do share some content areas, the focus is different. ISSB is for investors, focus on financial materiality, and GRI is for broader stakeholders with the emphasis on impact materiality. But they are the competing frameworks. They're complementary. GRI is well known in the sustainability space, and ISSB aligns closely with financial reporting and corporate risk practices, make it's already familiar and intuitive for accountants and CFOs. So in practice, these frameworks work together. And for example, if your double materiality assessment shows that the particular impacts as water use or emissions not only affect people or the planet, but also causes a financial risk, that becomes relevant to investors as well, and it should be and need to be disclosed under ISSB as well. So think of this as a building a clearer, fuller picture for both investors and society, using each framework where it fits best. All right, and now moving to next section and then also going back a little bit to what we already signaled before about material information. And in this context, as we just noted, materiality has a different definitions for different reporting standards and audiences. And in identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. So once the company has identified those risks and opportunities, and then can determine what information to provide about those risks and opportunities, and this is the moment where our materiality definition comes into play. So definition of material information used is in S1 is based and aligned with definition from the IFRS accounting standards. And it is information that, if omitted, misstated, or obscured by other information, could reasonably be expected to influence investor decisions. In other words, the ISSB standards seek to identify disclosures of key information that matters to investors. And entity determines what constitutes a sustainability-related risk and opportunity based on its facts and circumstances. Entities often have already well-established processes for identifying, assessing, and responding to sustainability-related risks and opportunities as a part of their management of the businesses. Okay, and going further, investors have asked full disclosure of material information, and the ISSB standards have been designed to help you gather and disclose it. However, this means that a company does not need to disclose information which is not material, even if the ISSB standards include it as a specific requirement. So a couple of things to remember here. you need to ensure that the material information is clearly identifiable and that you use a plain language. Also, that it's not scattered across your disclosures. And please do include any additional non-material disclosures if required by regulators, but ensure that it's clearly identified as such. And as already mentioned before, in November 2024, the IFRS released further educational material providing guidance for companies on identifying and disclosing material information, which we encourage you to look further into the detail. All right, and to then check your knowledge and understanding of the aspects we've just been talking about, we have another Zoom poll. So the question is, information should be disclosing the annual report when applying SASB standards, if, and then please do select all the options which apply here. So A, omitting the information could reasonably be expected to influence investor decisions. B, it could be reasonably expected to affect the company's cash flows. And C, it exemplifies the values of the leadership team. So I hope that should be fairly easy for you to answer this because we've been touching and mentioning what their material information and what kind of material information should be included in the annual report in accordance to ISSB standards. And I'm gonna close the poll right now. I'll look at the details and I see that most of you did it correctly. It's indeed about influence and impacting investor decisions, and also that which is connected to that impacting companies' cash flows. It's not, so A and B are correct ones. It's not about the values of the leadership team. So the C, the answer, the third one is incorrect. So well done to ones who answered correctly. All right, and now let's then go to their example, to the key element of this unit, so the location of the sustainability disclosures. So the disclosures and their ISB standards has to accompany the financial statements and be part of the same general purpose financial reporting package, but S1 does not say where in the reporting package the information should be provided. This is designed to allow jurisdiction-specific requirements on the location of reporting. The most important factor to consider here is to ensure that sustainability disclosures are part of the same reporting package as the company's financial statements, that they are provided at the same time, cover the same reporting period, and are authorized by the same body or individual authorizing the financial statements. And and so how to do it in practice, and how just to illustrate what are the options here, we have an example to discuss, and I'm handing over to Luis to show you this example. Over to you, Luis.
Thank you, Robert. And this example comes from Ayala again, our Philippines-based conglomerate, and it's from their integrated report. So we talked earlier about using the integrated reporting framework as support for your sustainability disclosure. And here we see that they've used the integrated reporting framework to show how they organize information. So they show which capitals are inputs to the business model, and those capitals are represented by icons. They show how value is created in the middle of the screen in the orange circles. And there also they provide us with links to pages where information can be found about the outlook, material topics, stakeholders, strategy, and so on. And again, the use of icons means that we can link the vision pillars to the focused execution we see on the right-hand side of the screen under value generated. So for really, this is a bit like an index showing an overall view of how the company creates value, but also references to pages where you can find information about different aspects of that value creation model and icons that help the reader to recognize where information is linked from across the report. Back to you, Robert.
Sorry. I think you can hear me better. Okay, great. You can see me. Should you see me now? Perfect. Thank you, Lois, for this example. All right, now we then moving to the next topic, very relevant. Here, and also Fiona mentioned, we will cover this one. It's about the role of technology. So indeed, the technologies and emerging considerations for disclosures, and increasingly corporate reporting is moving from the PDF reports towards information on web pages with structured data sets, such as the ones offered by stock exchanges. So IFRS Foundation has created the ISB taxonomy, which reflects the requirements and accompanying materials, the ISSB standards. So important to realize and to remember that the taxonomy does not introduce a new requirement. Digital taxonomy provides the common elements or tags needed to make your sustainability disclosures machine readable. This makes it easier to take large data sets like information from entire industry and bring them all together to analyze them. So their digital reporting has a number of benefits. It makes the reported information easier to use for analysis. Data is structured in the same way across businesses in a machine-readable format. Tagging information potentially allows for automated checks for quality and consistency. And more data collection and management systems are compatible with digital reporting taxonomies, improving processing and report preparation. So tags can have labels and descriptions in multiple languages. So if you report your quantitative data in one language, someone speaking different language would be able to understand what it means. All right, and then moving to the next unit of this module about efficiency concerning efficiency, and I will talk about how to communicate efficiently and effectively. We added this to the training because the common we find from companies that there is growing reporting burden, but we hope to highlight is that when done correctly, efficiencies can be made to reduce the burden. So now let's talk about what effective communication really means in the context of IFRS M1 and S2. So a common misconception is that the more is better. So just throw everything into the report and it will satisfy users, but that actually goes against the core principle of fair presentation. So instead, we need to ask, is the information clear and easy to understand? And is it concise without an unnecessary repetition or generic boilerplate? And the clear here might mean using visuals, tables, charts, and diagrams alongside text to make complex topics more digestible. And concise would means cutting out what's not decision useful and keeping the language direct and focused. So in short, effective communication is not about the volume, it's about relevance, clarity, and usability. And then let's talk about quality of information disclosed. So some of you might still be wondering what's the big change here, especially if your experience is mostly standalone sustainability reports that haven't been subject to the same level of scrutiny as financial reporting. So to all the accountants which are listening us today, this is your moment to support your colleagues, help them understand the level of rigor expected in data collection, governance, sign-off, and assurance. So that means, for example, you need to provide comparative information and restate it if needed, should avoid duplicating information and use cross-referencing when appropriate, make sure disclosures are material, well connected to the overall report, and that the data is appropriately aggregated or broken down for clarity. This is about raising the bar, not just reporting, but reporting with the same discipline as financial statements. And I mentioned cross-referencing. So as may you have already noticing, there will be some overlap in the disclosure topics. So, for example, you might have the same governance approach for all sustainability issues, and then rather than to duplicate certain information, you can use cross-referencing to enhance efficiency of your disclosures. So, regarding cross-referencing to other reports, it is permitted as long as the other report is available on the same terms and at the same time as the sustainability disclosures. The cross-reference information is assumed to become the part of the reporting package. So it should be also applied consistently and transparently, and cross-referencing shall not result in the information becoming more difficult to understand. And the way to do it, we have another example, again presented by Lois.
Thank you, Robert. And this is an example from the sustainability report of a company called ArcelorMittal, which is a multinational steel company. And as any of you have read reports know that they can be very, very long, and it can be quite hard to find information. So in this annex from their report, what we see is how they map to the areas of their 2024 report the content elements and core concepts of IFRS S1. So they list the content elements down the left, all of which we've described today: governance, business model, risks and opportunities, and so on. And then on the right-hand side, in the second column, we see where they report information in response to the requirements on these core elements and concepts. So in some cases, you can see with business model, for example, that the information is within the same report. It's in the sustainability report. In other cases, for example, under risks and opportunities, there is some information in the sustainability report and some in the form 20F. And similarly with strategy and resource allocation, information appears in the sustainability report, in the annual report, and in the form 20F. So an example of listing where information can be found that responds to IFRS S1, and clear navigation to the cross-reference where the information can be found. Back to you, Robert.
Yes. Yeah. Right. Yeah. Thank you very much, Lois, for this example. And I'll be talking about the mechanism that support the adoption. So it's to help the companies to get started with the ISB standards. We have at the IFRS Foundation, we built in several practical support mechanisms. First, we've kept these things familiar. So adopting terminology and concept already used in financial reporting, like those from the IASB. So this should help reduce the learning curve. We also made sure many requirements are in S1 and S2 are proportionate, meaning they can be applied based on company's current capabilities. For example, qualitative scenario analysis is allowed, and throughout the standards, you will see language like reasonable and supportable information without undue cost or effort, or commensurate with skills and resources. We also introduced a number of transition reliefs for the first year of reporting. So this includes, first one, the option to report only on climate-related disclosures in year one. So climate first concept, and add other sustainability topics in year two. Secondly, the ability to publish your first sustainability disclosures with your next half-year report rather than at the same time as your financials. And then there is a relief from providing scope 3 greenhouse gas emissions or using the greenhouse gas protocol if you're already applying another approach. Also, no need to provide comparatives in the first year. And there is also flexibility to include greenhouse gas data from value chain partners, even if they follow a different reporting cycle. So, of course, we also pointed to several supporting resources like the SASB standards and CDSB guidance to help identify relevant metrics and disclosures. So all these mechanisms are designed to make adoption manageable while still leading to high quality decision useful information for investors. And we have then we'll have two Zoom polls to check your knowledge. So the first one is about information and this accordance with the ISB standards and what kind of characteristics you should have, you should meet to be able to meet the standards. So please do select all which apply here. So it should be decision useful, material, misleading, or comparable. And please, we've been talking about it. I'm sure you'll be able to answer this question well. And I think we see it now. Some good answers coming in. I'll end poll right now. So indeed, the information disclosed in accordance with the SB standards should be decision useful, material, and comparable, and not misleading, and that should be fairly obvious. And again, the information is decision useful if it is. And then we have 4 options. Please do select all which apply here. So it should be relevant and faithfully represent what it proposed to represent. It should be comparable, C, verifiable, D, timely, and E, understandable. And please select the ones which are relevant in this context. And it looks like you do have a good grasp and you remember it well what we discussed. And yes, in this case, all the answers are correct. So A, B, C, D, and E are decision useful characteristic and features in accordance to the ISB standards. So congratulations to the ones who answered this way. All right, and I'll be moving to the last unit of this module and the last unit of the whole training. So we're almost at the end of it, and we'll be talking about confidence. It looks at how you can ensure that users of financial reports have confidence in data you're disclosing. So as a trust is essential component of sustainability-related disclosures, and increasingly so with the growing concern over greenwashing. And to start with, we'll look at the comparative information. So one of the simplest but probably most powerful trust builders is reporting is showing data over time. This is why ISB standards require comparative information. So comparatives give essential context that help investors see progress, assess trends, and understand how the company's strategy and risk profile is evolving. So, of course, metrics might change. Companies might refine how they define or estimate them. When that happens, it's important to revise prior year data so investors can still make meaningful comparisons. If there is a material error in previously disclosed data, then a restatement is required, but only when not doing so would mislead or obscure material information. This applies to both qualitative and quantitative disclosures. So now we know that companies sometimes hesitate to disclose forward-looking opportunities due to commercial sensitivity. And ISB standards do provide relief in this case, and companies are not required to disclose information about opportunities if doing so would compromise their competitive position. You will find more information about it in the handout. Right, and the last thing to mention here is statement of compliance. So finally, it's important to build confidence by providing clear statement of compliance. A company that complies with all the requirements in the ISB standards, even the reliefs, is required to make an explicit statement of compliance. There's also further guidance on this published in September 24 called Voluntarily Applying ISB Standards, a Guide for Preparers, which further explains this topic. So that's it about the statement of compliance. There's this on this last slide, we put together things to remember. Please do work through the list. You can find it in a handout, slide, an additional slide in this section, reminders on how to report effectively. And I do recommend reviewing that. So with this, handing over to Fiona for the summary of Module 4. Over to you, Fiona.
Great. Thank you, Robert, for taking us through that section. So as Robert says, we're now at the end of our final of the 4 modules. So almost there. So just stick with me for a little bit longer for a recap, and then we'll wrap up with some resources and the all-important aspects about your certificate. So to summarize what we've covered in our final module, we'll take a quick moment to recap here. So firstly, we discussed where to report information, and what was important here was the audience, or who you're reporting to. So being sure to be clear from the start who the primary user of the information is will help you to ensure that this information is ultimately right for their needs. And of course, when we're talking about the IFRS S1 and S2 standards, we're talking about investors as the primary user. We then moved on to discussing efficiency, and I think the key takeaway here is that less is more. So the objective shouldn't be to overload investors with information, because actually that could be harmful because it could obscure what is material. So using the standards as you get started can be a good guide to make sure that you're providing the information that investors need, which of course is the overall purpose of the ISSB standards. And finally, we discussed report user confidence, and especially in the current climate of greenwashing accusations and legal battles over public statements, you want to ensure that your data is not only accurate, but that it's presented in a way that builds confidence among report users. And so the reporting plan that we've been discussing, and that you could help use the homework exercise to further develop, will give you that clear and documented process for reporting the data that investors need. So to get started with this, we'll just take a brief moment for our final Menti exercise together to think a little bit about some of what we've heard so far and your reflections regarding the presentation approach for your information and the different navigation techniques that you might be able to use. So really, what techniques are there that you find are the most helpful to make reports easier to navigate? Obviously, we're talking about a lot of different information here. It may be located in different parts of the report as well. So what techniques are most effective in your opinion to support that? So again, I'll just quickly share my screen to have a little look at what you have to say about that question. Again, I see we've had some good responses through already, so many thanks for those putting in a good effort to give us lots of good content to discuss together. That's always really helpful from our side, so thanks again. So I'll just talk through some of those responses we've received already, and I know some of you might have some more ideas that you can share in the background as well. So we're mentioning here the clarity of the table of contents being really key, and I think that speaks to some of the examples we talked about as well. So having an interactive table of contents to locate specific sections, indeed. And so using clear structures and headings, and using a consistent approach to your headings to allow people to scan and find the information. And I think where possible, using the terminology in those headings that comes from the standards you're aligning to as well, gives investors that consistency to locate what they're looking for. We've then had visual elements, so using charts, graphics, infographics to break up the text and explain your data. Indeed, a mention of hyperlinks and cross-referencing again, so yeah, making use of digital reporting functionality, and using the different section links into external areas. Great. So maybe someone's also mentioned the importance of summaries as well. So getting across the key highlights and points at the start of sections or end of sections, I think is a very good suggestion. Using glossaries and appendices to help people to navigate perhaps some of the technical detail and avoid clutter, as that person says, I think is a very good strategy. Great. Maybe having a navigation bar on the side of the report, as is mentioned, so that you can come back and find comparable information or link between the sections. Lovely. I think lots of really good suggestions here. So I'm just skimming a little so we can see a few of those together. I think some of the similarity in the concepts raised here, but all very good ideas for sure. And I think, as someone's mentioned here, just reporting in the best interest of the company and investors, and yeah, really keeping that audience front of mind is very important. So great. I think lots of really good ideas there. And maybe someone's mentioned as well having company examples. Yeah, so bringing to life what you're discussing in theory with some worked examples of how you're delivering this within your business is very useful to illustrate what you mean. So well done. I think you probably highlighted there everything that we would have suggested and more. So thank you for all of those great ideas. So just to wrap us up, we have a couple of concluding mentees. So we just want to revisit that question that we asked you at the start of the session about how comfortable you were with the different objectives that we were aiming to cover today. So we're hoping you'll be a little bit further along the scale now, but just to give a second to reflect, I guess, on where you think you are now, maybe where you want to go away and understand more from what we've discussed as well. Recognizing, of course, that often a training session like this is just the start and there's still lots more to learn. But that's great. I think we're seeing a little bit of a shift along the scale overall. Still more to learn, which is obviously understandable. We recognize we can't solve all problems in one session, but we hope it's been a good signposting exercise. But that's great to see a little bit of a movement on the scale there. And then I'll leave this for you to answer in the background, but feel free to let us know your thoughts as well on what you most liked about the training. And we'll also have a feedback survey that we'll share with you at the end, which will give you the opportunity to highlight anything perhaps you'd like to suggest we could do differently as well, which is always very helpful. So just to wrap up on a few points that we've touched on already and some resources that will help you. So firstly, the homework assignment. So really, this is just something we want to share with you to help continue your learning journey, because we know a workshop like today is often just the beginning. And so you can find the homework assignment on the event webpage, which Lois has just shared the link to again within the chat. Thanks, Lois. So at the bottom of that page, you'll find the homework. And really what the homework does is follow the same structure as the different interactive exercises that we've been completing in today's session. It takes you through considering the 4 key steps of prepare, align, implement, and communicate. So if you follow through the structure of the assignment, it should then enable you to develop your first draft ISSB aligned disclosure plan for your company and allow you to put into action what you've learned today. So we really do encourage you to take that away and use in your own time if you'd like to do so. And just to mention, we've touched on lots of different resources today, but a few kind of key hubs you can go to get hold of these. So firstly, we have the IFRS Sustainability Knowledge Hub. So this is something, as we mentioned at the beginning, is really regularly updated with all of the different guidance resources, case studies, etc., that the IFRS team are continuing to develop. So make sure to check that out for a lot of the resources we talked about. Alongside that, we also have the IFC's work. So the IFC have the Beyond the Balance Sheet program, which provides a real comprehensive suite of information, particularly targeted at emerging markets, all around corporate governance, ESG, improving corporate practices fundamentally. So lots of different tools and guidance you can find at the IFC Beyond the Balance Sheet webpage. And again, just as a reminder, all the links here that are mentioned can be found in the slide handout that you can access on the event webpage. Just to mention a final time as well, we talked about it already, but the UNSSE toolkit is continuing to evolve as well. So we work very closely with the IFRS Foundation and other partners to support exchanges and their issuers on these topics. So make sure to check out our publications within the toolkit on our event page as well. And finally, maybe the part that many of you have waited around to hear about, but a big well done for everyone who's stuck with us throughout this full 3.5 hours of training. We know that this is a long time to be together and there's a lot to cover, so we're really appreciative of that. And so as a merit for your hard work, you can now receive a certificate of completion for this course. And if you are a member of a professional body as well, you can also hopefully claim the CPD credits for taking part in this program. So to receive your certificate, what you'll need to do is to fill out the feedback survey. So Lois is just sharing that link with you now in the chat, which you can see in her instructions is there. So if you follow that link and fill out the survey, we will send you your certificate. Also, if you missed the link for any reason in the chat there, we will also send it within the next 24 hours via Zoom as well. So that goes to everyone who joined us live for the training, because you do need to take part live to receive your certificate. But yeah, if you fill out your survey and if you leave us about a week time to issue your certificate, so don't worry if you don't receive it straight away, it is coming. We'll send that to you. So yeah, wait to see your certificate come from us in the next week. But we have our contact details at the end of the slides as well. If you haven't received it after a week, you can get in touch to check that with us too. But with that, just a final few thank yous from my side. So firstly, a big thank you to all of the SSE supporters who play a big part in making this programme possible. And also a big thank you, of course, in particular to the Muscat Stock Exchange, to the team there who've supported us in co-hosting today's training, and Majedi, who joined us for the opening remarks earlier as well. We really appreciate the collaboration to bring us all together. Of course, we'd like to thank the IFRS team, in particular Vanessa and Robert, who've joined us today, for sharing their expertise, and to the IFC who partner us on this programme. And all that remains is to say a big thank you again to all of you as the participants for joining us, for the great interaction and engagement in today's session. We hope you found it useful, and we wish you the best of luck with the rest of your endeavours on ESG reporting. So enjoy the rest of the day, and we'll close the session there. Thank you very much again, everyone, and all the best.